Ladies and gentlemen, welcome to the Midday Market Monitor. However, it's not just going to be a midday show. We are actually taking this show all the way to roughly 6 p.m. So over the next course of the next 30 minutes to roughly an hour, we are going to be covering general market news and, the price of the stocks that we end up following on a day-to-day basis. At 2 o'clock, we have the FOMC meeting. We'll end up seeing the rate decision, which is almost certainly going to be a rate pause. And in fact, the chance, I saw someone say in the chat that there's a chance that we see a rate cut. In fact, that's not what the Fed tool is saying. In fact, there's starting to be a creeping chance of a Fed hike. A hike, ladies and gentlemen, 1.1%. Let me drop the chat real quick. You can see this 1.1% of a hike, 0% chance of a cut. Now, this is just a probability. Obviously, there can be something that happens that was not, part of the expectation, of course, even with people like Steve Moran that will be dissenting and calling for a 25 basis point cut. It's not looking likely. The craziest part is that whenever we go out to full year, we actually see a 0.4% chance of one rate cut for the full year. This is new. 40% chance of no change, 40.1% chance of one rate cut. SoFi investors are not going to like this. The chance of two rate cuts or more, 15.9%. Once you add in the additional 3.5%, we're looking at roughly 16.4%. Or sorry, what's the math there? 19.4% total. 19.6% total. There we go. Did I get that wrong again? 19. Anyway. But still, the chance of multiple rate cuts not looking likely for full year. Now, I see a lot of people being very nice in chat. Thank you guys so much for being here. I was not banned technically. Essentially what happened, and for people that were watching the stream or maybe skipped the last 2 days and didn't know what the heck had happened, because you're not following me on X and you don't follow me on other socials, so you don't get the full updates. I was following NVIDIA GTC, an event that I was invited out to. Big NVIDIA investor. I love the people over there. Wasn't mad necessarily. They ended up seeing that I was showing off their content, which is not fully allowed. They had also suspected that I was using a non-official stream. This was the real story. So this was the official story. They thought that I was showing someone else's stream. I think that had to do because I have QR codes on my thing, but that's just to join the Discord, Anyway, they ended up copyright striking my channel for essentially stealing their content, which I was guilty as charged. I just didn't think they were going to get mad at it, which now I can end up streaming GTC, CES, any other NVIDIA events. We're a whitelisted NVIDIA creator now, ladies and gentlemen. We're actually got an upgrade. So give a round of applause to the future investing cult members in chat. We are going to be able to stream all NVIDIA content without concern. But yeah, it was a little bit concerning for a bit between the times of them actually getting it figured out and me just sort of waiting. I was not allowed to stream on YouTube. I could post, but I couldn't stream. Now that the NVIDIA GTC thing is back, the strikes are gone. No concerns about my channel. We're back in the good graces of NVIDIA, in the good graces of YouTube. But we just had to use Twitch for a single day. And now for those people that are still on the Twitch channel, thank you guys so much for being here. Mama, he made it. Thank you. NVIDIA cult members, future investing cult members. For real, the people who went to the Twitch, I think we saw a total of, about 900 people ended up coming over. I actually can't thank you guys enough for making me realize that the content has gotten large enough that it's not just YouTube. However, obviously, YouTube's the biggest one. it was an insane feeling to know people like Guy and people like Staples and all of these guys ended up showing up on the other platform to support. Steve actually donating 10 gifted in the Twitch yesterday. I love you, man. Thank you so much. But we're back. Okay, so let's get into the actual news. And like I said, this is going to be a market close stream, an FOMC stream, a Micron earnings stream. It's a long one. Buckle in. We're going to be here for over 4 hours. Let's take a look at oil really quickly. We're at $97.81 a barrel right now. I also saw this pretty great update on the overall war, the Iran war, which I think is pretty crazy. The U.S. and Israel have now struck 15,000 targets in Iran since the war began on February 28th, said the Wall Street Journal. Here are some of the war details. 50,000 American service members have now been sent to the Middle East to support this operation. U.S. and Israel have conducted over 11,500 combat flights. The United States has destroyed more than 100 Iranian naval vessels. The total cost of the Iran war to the United States is $25 billion, about $11,500 a second. That's a pretty good amount. This is how much I was actually losing, $11,500 a second after the SoFi short report, surprisingly. So pretty good coincidence, but luckily it hasn't gone on for 19 days. So I haven't lost $25 billion. Average U.S. gas price, total joke, by the way. Average U.S. gas price is now up 40% since December. We are now on the 18th day of the Iran war. Gosh. Okay. Let's go ahead and see SoFi stock, which has had another whirlwind of a day. But we're actually green. Still green. It wasn't as green as whenever we were $18 a share. It was like one of the, quickest short reports to have ever gotten swallowed up and spit out on the other end. And people said, all right, well, looks like Muddy Waters might have some legal action to attend to. Hopefully they afford some good lawyers. And I think they're pretty confident, which is quite interesting. They ended up making a post actually after SoFi came out and said we're looking to potentially sue Muddy Waters for defamation. They said, oh yeah, girl, run that game. Little Eminem gif here that Muddy Waters had returned this with. So they think it's a joke. They're joking around with SoFi. We'll see who's laughing at the end. Essentially, I had shared this clip from a podcast with Anthony Noto, where he specifically had said this.
So we're going to start actually publishing our point of view and maybe even have our own point of view on someone else's research. Why shouldn't we? Like, at the end of the day, we got to stand up and defend our company. We have a right to, make sure we're driving shareholder value. That may require us to tell people you're wrong, or this is an inconsistency, or you're not using the same standards. This is ethically not even correct. So we're going to.
But what do you guys think? Do you think it's right for SoFi to essentially end up clapping back? What's so funny is I think there's people have slight vendettas for SoFi. Maybe they had held on too long. They had sold the stock. And that whenever SoFi ended up coming out and actually making a response, they said, well, that's exactly what Enron would do. I'm like, okay, what would an innocent person do? Sit there and just do nothing? Like, people actually, I saw people say, well, it's actually negative sentiment that Anthony Noto bought more stock because he's trying to cover up. Like, what would you want? Let's think about it the other. I mean, maybe that's true, right? Maybe he's furthering the lie. But what would an innocent person do? Nothing? They would do the exact same thing. I think the fact that they are a fully regulated bank, okay, the fact that, essentially you're calling liars on the loan buyers that are saying that the quality of the loans are actually dog crap. You're saying that the auditors, Deloitte, are trash. The Federal Reserve, the Office of the Comptroller of the Currency, the Securities and Exchange Commission, the most regulated industry in the world, which is a nationally chartered U.S. bank conforming to generally accepted accounting principles of the United States, is lying. All those members, all of them, the insiders like Data-Driven Investing and Chris LaPointe and all of these guys, Data-Driven Investing is like an actual saint. Like, people don't know this. Like, I don't know what part of his personal life I'm able to share on here, but I mean, this person does more things for charity and the people around him than Chris does for his own self. And I mean that wholeheartedly, like a true saint. And you think that he's working for this industry. He's came out with comments since this actual report and said, you know, I stand with SoFi and this is absolutely the greatest company I've ever worked for. And all those people are lying. They're creating a large Enron-esque essentially fraud. They're not calling it fraud, but they're calling it Enron-esque, an actual fraudulent business. I'll take the side of the auditors, the regulators, the charitymen, all of this, versus the company that is designed to profit from shorting businesses and intends to sell his shares the same time that the company ends up finishing that report. Now, we ended up also seeing this. Can I show this? This is we're going to switch topic a little bit away from SoFi to Nebius. Nebius ended up coming out and saying, hey, we're no longer actually diluting by $3.75 billion if the convertible note gets past that strike price of $185. I'll have to check that. I think it might be 182, something like this. But it's a large upside, about 50+% upside from where we are today. And now people scream dilution, even though they just signed a $27 billion deal with Meta after a $3 billion deal with Meta. So Meta was happy with what they delivered, came back to 10x the deal. Stock fell 12%. Today they said, no. Actually, it's $4 billion with the allowance to increase the allotment by an additional $500 or $600 million. I'd have to check. But essentially, it's a $4.5 billion offering that most likely will be diluted. The cost of that convertible note, so it's debt right now and can convert to equity. That debt right now, I did this on Gemini. Let's go ahead and bring up just some of the math here. Where was it? The average interest rate paid on all that debt is 1.85% annualized debt. Okay. Annualized, that's $74 million to bring in $4 billion. And over the entire course, if it doesn't convert, if it's just debt, that's a total payment of $462 million to end up supplying a $27 billion deal. All right. It most likely will convert. I would count it as dilution. If you look at fully diluted share counts, which is essentially saying, okay, if we did vest every employee, if we did end up all the converts, everything paid out, that will end up stepping up because of this $4 billion deal and the $2 billion deal with NVIDIA as well. That being said, the interesting part about this whole strategy of it being down 12% on yesterday's news, and then they stepped it up even further today, Nebius is up 4.1% on the day. I mean, that's pretty decent. DLocal earnings today as well. So for those of you that didn't end up watching the GTC event because it literally got deleted from my channel, at least, I'm a big shareholder. Well, not a big shareholder, but DLocal is a position in my portfolio. So we'll be looking out for that, but we actually won't be listening to the DLocal call because I actually created a swing trade on Micron. I'm doing an earnings play. It's not something I usually do, but I'm praying for good guidance on Micron. I don't see a way that we don't get that. Hoping for the best there. That being said, we're going to be listening to Micron's call because not only does it affect my swing trade, it also affects, all the hyperscalers, Meta, like the massive AI companies, neo clouds. It affects the supply chain. It affects my biggest position, NVIDIA. So that's what we're going to be listening to. Okay, Xnub said a swear word, and then he said, he did a bet, we're going down, I'm selling. Xnub, your name is being recorded, okay? And we're going to see who's right. Sick of these comments going past that hold me to the fire and then get to back away in anonymity. And I don't get to come after them, Xnub. So your account is officially on red notice. If we go up on earnings, I don't know. You have to donate to keep your chatting privileges in this chat. That's what's going to have to happen. SoFi Sloth says, Tanner, you should only trim your mustache at SoFi Earnings because it is already going to go down anyway, as per usual. That's very funny. Okay, let's check the Qs. Q's down 0.5%. The SPY is down 0.6%. Remember, we have FOMC in roughly 12 or so minutes. So we'll get that whenever it comes out. Let's make sure that we're following this. Oil is falling. Let's see how this ends up trailing here. It should actually put some decent positive pressure on the markets, but maybe not if people are thinking it's only short dated, especially if it starts to come back. Nebius, nice recovery. Oh yeah. The recovery on Nebius, now up 4.3%, is looking juicy. I still would like more Nebius if I can get my hands on it. But yeah. Nebius, wow. Nebius, wow. I've been working hard today, Tanner. What did I miss? Well, X was down, so I think a lot of people missed the news overall. We ended up seeing news on SoFi. We ended up seeing a lot of news, actually. We should listen to this. Most recently, we had Paul Atkins. Where is this? He was talking on crypto. Where's the full interview? Let's watch the full interview of Paul Atkins talking about crypto. Let's also check the crypto prices right now. Ethereum down 5.3%. And Bitcoin, let's check this. So we're back down to 2,200 on Ethereum. Bitcoin, 71,600. I was really hoping for that run to continue, but I guess we have to wait a little bit longer. Okay, let's have a listen to Paul Atkins really quickly because it looks like they're making some changes, and this could be a large benefit to crypto overall. And then we have FOMC.
Clarifying its position on crypto assets, interpreting digital commodities, digital collectibles, digital tools, and stablecoins not to be securities. SEC Chairman Paul Atkins joins us live from Washington this morning. This is a pivot of sorts. Help us understand, and we'll probably get into the weeds of it all in terms of just the mechanism for all of this, but how you landed on this decision and what it means.
Oh, well, thank you, Andrew. It's great to see you again. And this follows up on some of our prior conversations about this and other topics when you've been gracious enough to have me on your show. So thank you very much. But first of all, yes, yesterday was a real break with the past, a formal break. The commission came out for the first time with an interpretative release that really sets a line between what are commodities in the digital asset space and what are securities. And the significance also about this particular release that we did is that the CFTC participated with us in it. And so they had some guidance that's included in that release along with our interpretation. So basically, as you said, and that tripped off your tongue very well, so it's very good, we are outlining 4 types of assets that are not securities. And those are digital commodities, digital tools, digital collectibles, and stable coins. And stable coins per the Genius Act that was enacted last year. So we're breaking with the past. We are now giving clarity from the SEC's perspective as to what are and are not securities.
Okay, so it's funny, as I was looking through the list, the one I wanted to actually focus on, oddly enough, was digital collectibles, because I could see how a digital collectible, perhaps more than the other three, could be considered a security depending on how it's structured.
Well, that's true with anything. And so this is also what this interpretation lays out, is we're looking at, there's a old case from 1946 before the Supreme Court. It was called SEC versus Howey, and it had to do about orange groves and that sort of thing. But today, obviously, with digital assets, those principles apply. But what we are focusing on is what makes an investment contract, which means what makes a security. And we're focusing on the promises and the representations that the people who are constructing it make to their purchasers, their investors. And
we will get back to that, but XNub is right. We are going to have FOMC here in the next few minutes, and we will be covering it live, as well as the conference. We'll be listening along. Jay Powell's last meet. Trump administration expected to lift summer gasoline regulations to curb energy prices, sources say. Summer gasoline regulations. I'm not an American. What is this? Is there some sort of rule that they can't do for the environment? Anticipated waiver of seasonal restrictions on summer blend gasoline, allowing year-round sales of cheaper E15, 15% ethanol fuel to combat rising pump prices amid U.S.-Iran tensions. Cool. Different blend. Blends. The deregulation discussed in early March 2026, sources like Economic Times, could lower gasoline costs by 5 to 15% per gallon by substituting pricier reformulated blends, benefiting customers but potentially reducing fuel efficiency. Okay. Understood. Yeah, the SEC ruling on crypto is very interesting. I honestly, Paul Atkins has been great for the crypto community so far. Now, the prices have not, we're not in the season for strong crypto prices, but overall the regulation has been positive. Oil now at $96.64 a barrel. We're 5 minutes away from the FOMC. It's almost like a 100% chance. It's nearly 100% chance that there is no Fed decision. No cut, and that there's no change, I should say. Not that there's no decision. There's no change of decision, of policy. Okay, let's go to FedWatch really quick, and then we will get to the meetings calendar here in a second. We've got 5 minutes away. Gotta love that. But overall, 98.9% chance of no change, 1.1% chance, not of a rate cut, of a rate hike, ladies and gentlemen. The market could crash if we see a rate hike. I don't think that would be very great, especially for names like SoFi. Did I miss the Micron earnings part? Micron earnings at 4 p.m. Eastern Standard Time. That's 2 hours away. Earnings call is at 4:30, which takes us to 5:30 for the call. We'll also have DLocal in there as well. It's going to be a busy day. I'm going to buy some stock before FOMC. In what? Here, let's actually see a poll here. Are we, or sorry, what is the Fed Decision. That's what I'll say. Cut, no change, or a hike. Put in chat 1 for cut, 2 for no change, and 3 for hike. I'd love to see your guys' expectations. Fed will not cut rates. Look at the 2s. Look at the freaking 2s. I think it only works for 1, and yes, it works across Twitch, and it works across YouTube as well. Hike, 13% chance of a hike, 3% chance of a cut is what you guys are saying right now. We are minutes away. Do you believe in miracles? So I think you need to say 1. I don't think you can say 1 and then type. So, and Dookie, that does not work. You're a mod in spamming. No spamming. That does not work. You can only apply 1. It is tracking your account. So if you've already given in your number, it's not going to change. Definitely 4. Okay. Nate, what's up, brother? How you doing? Types in 1 first and then says hi. That's a man of economic certainty. 10% chance of a rate cut, 79% chance of no change, which I should add in mine as well, is definitely going to be 2. I mean, that's just my vote. And then 3 for a hike, 9%. Now, currently, the rate is 98.9% chance of no rate cut with 1.1% chance of a hike. So the retail investor is a little bit different than the economist. But hey, we're a sporadic bunch. Okay, 60 seconds. Let's get ready for this. I'm also going to pull up CNBC. I'm sure they're going to get the numbers hopefully as early as I do. So let's.
Inflation, we know it could be a transitory shock. We have a temporary, potentially temporary spike in oil. Ultimately, what is this?
It's still roughly 25 or so seconds away. I'm going to also bring up the calendar, just in case if they're a little slow, that we do have the FOMC calendar here, and I'll be able to pull it up as it releases, as well as X. So we'll get the number, we'll get the full commentary. Yeah, should be good there. Let's switch over to CNBC, see if they have anything to say. I'll stay quiet because I know it's a little bit quieter than me. Let's have a listen.
In their summary of economic projections, I'll be watching for whether they're going to upgrade their view on inflation, downgrade their view on the economy, given that fourth quarter GDP came in sub 1%, and what are their views on the employment market. Now, the bulls and the dovish members on the Fed are going to say inflation's here today, but slower economic growth is here tomorrow. We can still get 1 or 2 rate cuts into the books later this year. Markets are currently predicting only 86% chance of 1 rate.
Nothing just yet. Oh, actually, I see someone just posted Fed Chair Powell holds rates unchanged as expected. It was 2, ladies and gentlemen. That's what I'm seeing right now.
The next 5 seconds, Kalshi's odds for the next Fed hike, 60% before 2028, 37 before 27. Steve Leisman has the decision. Hi, Steve.
Unchanged. Federal Reserve leaving interest rates unchanged at a range of 3.5 to 3.75. It was an 11-1 vote with Fed Governor Steve Micron again dissenting, preferring to cut rates by 1/4 point. The Fed saying very up high in its statement today that the implications of developments in the Middle East for the U.S. economy are uncertain. But other than that, pretty robust or actually positive economic outlook. It continues to say, as it did last time, that the economy or the economic activity is moving at a solid pace. Say job gains have been low, but the unemployment rate is little changed. Now, as for the outlook, still one cut built in this year for the median Fed official, bringing the rates down to 3.4, and one cut for next year, another additional cut for next year at 3.1%. The long run, something that's been ticking up over time, the long run neutral rate is now see at 3.1. That is up a tenth. On inflation, the median Fed official now looking for 2.7 on headline inflation. That's from 2.4 in the December forecast. Going back down to 2.2% in 2027. On core, looking for 2.7, up from 2.5, so 0.2 added there. Interestingly, GDP actually taking a tick up to 2.4 from 2.3 and 2.3 from 2% in 2027. So not seeing much of a GDP hit from the higher inflation forecast that is now part of the outlook. As for the dots, 7 officials want to hold, 12 want to cut. At least one cut or more. 5 of those want 2 cuts or more. The old range, guys, was a funds rate from, if you take all 19, the bottom was 2.1, the top was 3.9. It's come in a little tighter. Now it's 2.6 to 3.6. So a little bit of give on the dovish side, a little bit of give on the hawkish side, and now you have a little bit more centered around this 2.6 to 3.6 area. But again, the Federal Reserve emphasizing uncertainty. Interestingly, I would point out the idea that they upped their inflation forecast, but also they upped their GDP forecast. So that's kind of telling you perhaps where the center of the board is on the ultimate impact of the oil price shock. Guys?
All right, Steve, stick around here, please, because we have markets that are relatively stable right now, maybe not unexpected. We're all waiting for the press conference. Let's get out to Chicago for the reaction in the bond markets right now. Rick Santelli has that story. Rick.
Yes, Dom, if we look at all the intraday moves, 2s, 10s, and dollar index, what jumps out at me right off the bat is that the fixed income markets, 2s, 10s, the whole curve, we started to see yields drop even before anything was read at straight up 2 o'clock Eastern. So investors were buying treasuries in front of the statement, and after the statement, it had just a minor follow through. We're at 370 in a 2-year before anything was read. We're at 269 now. We're at 421 in a 10-year, exactly the same. So you're correct. Not a lot of movement in the markets, but let's put a face on this. If we look at where we've been, on the 12th of this month, we saw 2-year yields at 3.74. The high yield close going back to August of 25. And if you looked at 10s on the 13th, they had 428. A high yield close for the move post-conflict, but they couldn't even take out their 429 high yield close earlier in the year in January. So really what we're seeing here is the 2-year yields seem most sensitive to the notion that we're not going to potentially get any more rate cuts, but that didn't change today. That's been the way it's been moving, flattening the yield curve, which, by the way, hasn't really moved much in the last couple of hours. And ultimately, the dollar index, well, the dollar index is up on the day. It was up on the day. It gave up a few ticks, but hardly at all. We've had a couple of bouts over 100, which is very unusual. We hit 100.36 on the 13th. That was a high watermark all the way to May of 25. So to summarize, listen, the conflict is an awful thing from a humanity standpoint. From the market standpoint, especially treasuries, it's been mostly well behaved, obviously higher interest rates, but maybe the poster child for how it's dealt with this is that the 10-year couldn't even get a higher yield close than pre-conflict. And of course, the dollar index, I'm not sure it's a flight to safety. I think it's more a function of the ECB. We're talking about our central bank. ECB tomorrow, most likely they're going to be looking at aggressive tightening because the energy situation outside of the U.S., whether Europe or Asia, is changing all the dynamics on potential inflation and central bank activity. Back to you.
Thank you, Rick. Just want to turn to the panel here, David, for some.
Okay, don't care about that. So, quick summary here. Once again, that the Fed rate cuts. The Fed halt rate cuts for the second straight meeting. I'll bring up the markets really quick here as well. The Fed also projected 1 rate cut in 2026 and 1 in 2027. That would not be as exciting to me as seeing 2 or more cuts this year for sure. And that even lines up with SoFi's own expectations. So that would not be good. Fed's 2026 PCE inflation forecast was revised higher to 2.7%. The Federal Reserve says that implications of the Middle East developments are uncertain. Stephen Moran ended up dissenting in favor of one interest rate cut. He said he was going to do that before. We said that was going to happen. He followed through. I mean, dude's a permadove. And today's rate decision reached a total vote of 11-1. We believe December was Fed Chair Powell's final rate cut. Wow, what a statement. Yeah, I think this is his last meet. Am I not mistaken? The next one is April. So, okay. But what is it? May is whenever they'll be looking to get in Warsh. It doesn't matter what they say about the future with the new Fed chairman. We'll see 2 rate cuts at least. Have we stopped being calling Warsh like hawkish, or is that still going on? I hope Powell is super hawkish. Dookie, that's because you're one of the few people that knows how to make money on the way up and the way down. For people like me that only know how to make money on the way up, you shut your mouth, okay? I can't make any money on the way down. We make money when rates get cut and SoFi lends out some more money. Honestly, either way the decision ends up going, it's not going to make a single change for the companies that I'm holding, like NVIDIA and stuff like this. So I honestly don't care. Yeah, we're permadoves over here. No, I'm not a permadove, but obviously I would like I would like SoFi to make some short-term money, but maybe that's me just being a little bit talking up my own book. Warsh is hoggish? Hoggish is one I haven't heard before. I make the water muddy. Think about it. Dookie pie. Okay. Someone said that I was drinking muddy water, which I guess it is. It's just bean water. Isn't that weird? Okay, so cool. The market doesn't really care. No change, was exactly as expected. We'll hear from Powell, and I will be listening to the full meet at 2:30. But after that, ladies and gentlemen, I need to have like a stream schedule on screen. After that, we will have market close, Micron and DLocal earnings, for which we have stake in both of those. So hopefully beats across the board. However, LATAM companies have just been getting destroyed recently, but Melli and Nubank had good earnings. The weakness of the dollar actually made the strength of their non-US dollars, but we'll have to see how that all plays out. Yeah. That could be Marshall's first task. Yeah, I'll figure out something to do for Marshall. I also see that you've made your way over to YouTube, Staples. You've abandoned the Twitch game. Why do you prefer Nubank over Melli? I like the management more. That's one. I love David Velez, might be one of the greatest CEOs of all time. I think their business is easier to understand. I think less moving parts means you could be more focused. The overall success and the growth has been great. B-Dubs, what's up, brother? Yeah. Did you get more information regarding SoFi? Well, there wasn't too much. Essentially, even KBW, one of the biggest bears for SoFi stock. So look at this. I'm curious to see how SoFi is reacting to this news. Even flat, but the one rate cut is not great. But however, we are down at $17, so maybe it is priced in since last earnings getting cut practically in half. KBW has a $20 price target on SoFi. Timothy Switzer, who is the analyst for KBW, had a $6 price target in the past and has since brought that up to 20. He is one of the more bearish people, and yet his price target is still above the stock price today. That's not always the case for SoFi. He said that they looked thoroughly through the short report from Muddy Waters and essentially found nothing that they didn't already know about. Obviously, there were some real concerns, like fair value accounting, like the dilution, like some of this stuff, but they said institutional investors fully are aware of that. He said that the stock reaction going forward is likely to be more dependent on retail investors who are less aware of the intrinsicies, not going to try to say that word again, of SoFi's accounting and business model. The analyst told investors in a research report that while they believe that the short report raises some new questions, it's not going to change their stock price, and they ended up keeping a $20 underperform rating, but a $20 price target on SoFi. So even though they're bearish, they did not make a single change to the outlook of the company. Now, for what's called the new questions that they raise, I absolutely agree that there are new questions. The problem is there's sort of like there's two things that the short report from Muddy Waters either did. Let's say three. One, they brought up things that were so easily refutable, like the 6.1% default rate on personal loans, like the 30-day delinquent loans that couldn't have grown quarter to quarter. There were a few of those, like just immediately out the gate, they were wrong. Then there was the category of things like fair value accounting and how it's not optimal versus CECL and stuff like this. We've heard this from institutions forever. I get that. Okay. And then lastly is the ones where they're like, oh, we believe that they might be working with other institutions to have essentially like shell corporations where they can sell off their loans, then so they have off-balance or loans on off-balance sheet businesses, like they're lending off balance sheet. And how do you even prove that one way or the other? So there's things that I just can't even make comment towards. They're calling it fraudulent and all this stuff. It's like, okay, well, I don't know how you're coming to this conclusion, but anyway. But yeah. When does Powell talk? 2:30, 15 minutes from now. Powell will be live. We will put that on screen when it gets here. But we have the live stream ready to go. Okay. What's Dookie saying? I wouldn't buy now. I'd wait for a dip. Buy it under 6. Buy what under 6? What are you buying under 6? What's my exit price if I bought 500 shares at 6.45? What stock? Okay. SPY 666, we're cooked. Maybe that's not a good omen. Ethereum at 2,200. I mean, with a perfectly expected no rate change, the dots stayed pretty much exactly where they were before. Everything kind of stayed the same. You're not going to see much swing in the markets today. You know, it all kind of stayed flat after we found out the numbers. But we will end up getting some commentary from Jerome Powell, and I think that he's going to be more cautious than not in his commentary while the Iran war is going on. At what time are DLocal's report? That's 4 o'clock. 4 o'clock. I'm pretty sure they're... Oh. What's happening? Nothing. Let me go to X. Okay, hold on. If anyone has anything, let me know in the chat. But I actually think this is not related to. I'm assuming that this is war or Trump talks rather than Fed talks. I can't imagine there's anything being found in the Fed discussion that is still coming up right now. The Fed kept Cuts path. Sorry, Fed kept the cuts path unchanged, still showing one 25 base point cut in 2027, another one in 2025. We knew that. Market's already starting to rebound. Okay, I'm not seeing anything for that red candle. Stream is live. What, the Fed stream? Let me bring that up. I have it right here. Okay, well, it is live, but it's just playing music and showing this. So we will be live. But yeah. We will be live for that. Okay, QQQs. Relax, it's just a red candle. Just a red candle, dude. I'm losing money. I'm losing money during red candles. That's you have to freak out during red candles. Oil's up, yeah. Crude oil right now almost flat on the day, 0.15% change to the upside. 96 dollars. 36. That's funny. 96.45 a barrel. And maybe as it slowly ticks back up, the S&P will end up following that pricing right there. Okay. If you're currently not an investor in Micron, would you say getting in now would be a bad decision? I got in like 2 days ago. I bought in before earnings, for earnings. So now this is completely a trade for me. So don't expect me to hold it long term. I'm just essentially betting on guidance will increase because of the supply constraint for artificial intelligence. I don't think that there's a slowdown in purchase orders. We saw that from Jensen Huang. We saw how important Micron will be for the Vera Rubin platform and for, well, even the, current architecture as well. So I'm expecting a good move on earnings. You're trading Micron just with shares, So I have the optionality to hold a little bit longer because even the earnings that happened a little while ago, where was it? I think here. We ended up seeing earnings and the stock popped like 5%, but they actually beat by like 60%. And it took a little bit for that to get priced into the stock. So if we do end up, holding for a little minute and then popping on earnings over the next weeks, I'm going to feel it out, but it's going to depend on how good the earnings actually are. But I'm expecting, strong earnings. Yeah. Nebius, wait for a drop. It's so hard for me to wait for a drop on names like this whenever they're growing at like 500%. Actually, there was a video. I didn't actually end up getting to see this. Let's take a look at this really quickly. We had Jensen Huang make a comment at GTC about about Nebius, but I didn't end up getting to see this. So let's have a listen.
Nobody is a better cheerleader for you guys. I'm sending business to you guys all the time. Nebius will take care of you. Everybody who doesn't have Nebius will take care of you. You see those names? Yeah, Nebius will take care of you. Actually, that's our new tagline. Nebius will take care of you. Nebius will take care of you.
You can hear, and Mark here, who is their chief revenue officer that he's talking with, literally tried to correct him. He's like, please stop calling us Nebius. But that's why I say Nebius, because Jensen says Nebius, but it is Nebius. And you heard it from Mark, the CRO. He's trying to correct him, but he's also realizing he's talking to the king. So he's like, okay, I'll kiss your hand. Yeah. Okay. Let's see here. Private credit investors' exodus is spreading to consumer loans, according to Wall Street Journal. Interval fund Stonebridge Asset Management, which holds consumer loans made by Block and Affirm, are apparently under stress due to redemption requests. Stonebridge honoring 11% of the redemption requests. Block and Affirm are selling off on this new article. Wow, that was posted today. That is probably what's putting a little bit of pressure on SoFi today. Oh, wait, you're not seeing my screen. My bad, guys. I got to get better at this. We have the FOMC here in a couple minutes, but Block ended up selling off on that news, and Affirm ended up selling off on that news, and that's why SoFi ended up losing its run this morning, now into the red. It has nothing to do with the short report. It has to do with the Wall Street Journal saying that private credit investors are spreading to consumer loans. However, both of those companies deal with lower-end consumer loans. Affirm and Block deal with subprime customers. My mic? Okay. Yeah, okay. Klarna's down 7%? Oh, wait, what's their thing? I typed in Flarna. The heck is Flarna? Down 7. Brutal. That's one company I would not hold, Klarna. I might actually end up getting a stake one day in Affirm. I actually think they're a real winner. But Klarna, don't like the management. I don't like the way they talk. Not a fan. Okay. Yeah, Nebus. I love Nebus. Like the saying Nebus is great. Look at that little guy. Have you ever looked into Grab? I have looked into Grab. I'm not a fan, but I'm not anti the company. I just, sometimes you need to get a feel for a business. I get no feelings. I get no butterflies in my stomach, but like whenever I look at Nebius or SoFi or some of these companies, I just go, oh man. Nebius makes me feel shy. She's one hot woman, and I can't contain myself around her. J-Dog is J-Dog live. J-Dog will be live in 6 minutes. Yeah. 6 minutes, and that doesn't even mean that he'll step on stage at that point, but we will I've got it on my screen. Nate says, "You're telling me." I know, brother. I know. She's a flirt. Ever looked at Lemonade? I've looked at Lemonade, but I don't know. I've not taken a stake in Lemonade, nor am I looking for a stake in an insurance company when Nebius is on the field. This is we're in Miami. We're in a Toronto bar right now. There's a lot of beautiful women. That doesn't mean I get to go talk to all of them. I'm talking to Nebius today. So Lemonade's just going to have to wait. Let's see here. Google has updated Stitch into an AI native design canvas for high fidelity UI for prompts and images, text, or code. It now adds prototyping, voice editing, and design systems, putting it more directly up against parts of Adobe's design workflow. Doesn't that also go directly up against the other, Figma? Chime's down. Well, Chime is also low-end consumer credit. They have instant loans. Tanner's getting baited by Femboy Nebula. No, man. She's a real girl, and she's cute, she's hot, and you know what? The dilution, all that is a little bit of student loans, okay? Doesn't make her less attractive. It's just I need to pay some bills for her. She's high maintenance, but it's fine. You need to be able to afford a girl like Nebius. I can handle a high maintenance Nebius. FOMC is in 3 minutes, ladies and gentlemen. 3 minutes till we get what we're looking for. Is chat only for subscribers? Oh, I need to change that. That was from the bot thing. I can change that. We got a bot attack. It still might be in subscriber only. We can take that off. But how do... customization. No, anyone can chat. It's not for subscribers only. It's for anyone. But we did have it in subscriber only after the GTC event. We had a pretty crazy bot attack, and I didn't know what the heck I was doing. Imagine if we get a rate cut. That would be funny. We are already past that. We are not getting a rate cut. That decision's already been made. But now we get to ask Jerome Powell a couple questions in terms of, hey, like, you know, why didn't you cut the rates? What would lead you to cut rates? Why'd you wear a blue tie today? Which it will be a purple tie, but, you know, still. Do you think it's worth selling a bit of SoFi for Micron earnings play? No. No. It's a small amount of money that I'm playing with. I'm just having a little fun, you know? I'm just having a little fun. That's it. Don't sell your favorite positions to trade on a name that you might not actually know much about. VG is up 7.7% to nearly $14 a share. Let's not forget we had a chance to buy this in the $5 ranges and like fully staring at the chart and everything. But I don't buy what I don't know. But I do know the AI trade. Micron's going to be a big part. What if he wears a red tie? I think that means that Trump gets a third term. I think that's what that means. No, I'm kidding. I don't know. I mean, to be honest, I don't think he will wear a red tie. What's your price target on Nebius? I don't really do price targets, to be honest. I look at the total addressable market. I think that the company will be servicing a market that's not even 10 times bigger. I think it's going to be 50 times larger. And like a growing business, I know people point to unprofitability and these sort of things. They're not selling the tokens unprofitably. They're not taking losses on customers as they are. But the level of build, hiring new headcount, engineers. Oh, Jerome Powell's stepping. They immediately put him on camera, and he's already at the desk.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net, we didn't make progress. And if you look at total core inflation, it's about 3%. And some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind. And the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially, it is that the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction that to your point, if we have high if we have a long period of much higher gas prices, that's going to weigh on consumption. Now, it'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We have, we're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things. And you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that. And we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined. What gives you confidence that inflation returns to target over the next couple of years?
Okay, so I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now is just kind of on that borderline, the higher borderline of restrictive versus not restrictive. We feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chappelle. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can, we're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, we're a full percentage point above 2% for some time, and that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply side story, has changed despite the quite negative number in February. Would that be the right take? And was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to realize, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks. And, you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, there's people have written that paper and that speech a number of times. A number of people have tried to make the case that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much. And I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes we made to the framework. That was a critical thing. So we didn't. And, I wish we had been able to do some things, but we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January, some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy warning would there be?
So it did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case. And of course, we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question now?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing, that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens. And it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service and business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by a tenth, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and the downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal. And we have inflation that's, 1 percentage point above that. So calling that stagflation, it's not, I would reserve the term stagflation for, a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s. And I reserve stagflation for that, the word for that period. Maybe that's just me.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. President Trump says that oil prices and overall inflation will go down very rapidly as soon as the war ends. Do you agree with that?
I don't have a forecast on that.
When we're thinking about the impact on American households, as you know, they've been facing these higher prices for years. They've seen an almost $1 increase in gas. How worried are you about households, especially lower income families, being able to afford those price hikes? And should people be bracing for higher costs, including for food now?
We don't know how big these effects are going to be, and I don't want to characterize them in any way. Of course, people are already seeing gas prices. Gas prices are up almost $1 a gallon. We hope that isn't for a long period of time, and of course people will feel that, but I don't want to speculate about what that might mean, because honestly that would sound like I have some idea of what's actually going to happen, and I don't think anybody really does. We're going to see how this works out, and I just would leave it at that.
Victoria.
Hi, Victoria Guido with Politico. I just wanted to ask, for purposes of the next meeting, how the Middle East war develops between now and then, how are you thinking about what might guide action at your next meeting? I mean, if we have oil prices, above $100 a barrel the entire time until the next meeting, is that going to change your wait and see stance? Like, what would lead you all to move, or are you on hold pretty indefinitely?
We'll have to wait and see. I mean, we always say we're going to learn more by the next meeting, and usually we do, but in this case, we're going to learn a lot, because we're going to learn 6 weeks to the day till the next meeting. And we're going to see whether what happens is it's going to be very important for the way the economy looks and the way the outlook evolves with what happens in the Middle East. That's going to be a big factor, and we'll know that then. I don't know how it's going to affect our thinking. I really don't. And we did talk about alternative scenarios a little bit, but it's just I wouldn't bring that in here. It's very uncertain, and I just want to remember that we don't know, and we shouldn't assume it's going to be one thing or another. We're going to see.
So is it a matter of you don't know how the situation itself is going to evolve, or even if things remain as they are, the economy could still remain relatively durable in face of them?
Yeah, that's true too. No, I mean, the U.S. economy has just, made it's been strong through a whole bunch of challenges. I mean, if you go back to 2023 when we raised rates a lot in 22 and 23, and close to 100% of economists called for a recession, which didn't happen. In fact, 2023 was a really strong year. So the U.S. economy has really been just doing pretty well through a lot of significant challenges over the past few years. It's been amazing to see. And I don't know what's going to happen in the next intermeeting cycle, and I don't know what's going to happen in the Middle East. I wouldn't want to speculate.
Hi, Chair Powell. Thanks for taking our questions. What makes you so certain that tariff-related price increases will be a one-time effect? I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start expecting still more tariffs the next year and still more tariffs the next year, they should be a classic one-time thing. People say the same thing traditionally about an energy price spike, because traditionally prices go up and they come back down. And by the time monetary policy would react, it would be over. So I don't have tons of confidence on that. I mean, I think the theory is probably right, but as usual, the time it takes to get all the way through the economy is just very uncertain. And we found that coming out of COVID, that the inflation did go away, and largely for the reasons we thought it would, but it took 2 years longer than we thought. So I think we have to be humble about knowing how long it will take for tariffs to go all the way through the economy. And so what we've been doing is our staff's been doing, it's very interesting. They started off with just an estimate because there wasn't a real history. And then they've built, based on the history that they're seeing of tariffs coming through into prices, they can now have an arc. And for all the tariffs, they can say, well, so we have, I think, a slightly more confidence that we will see tariff inflation coming down, not prices, but you won't see further increases. And we should start seeing that more and more in the middle parts of the year. We do expect that. Now, you're also right, though, that the level of tariffs came down fairly meaningfully in the wake of the court decision. But the administration said they're going to get that rate right back up to where it was. So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Chris Rugaber.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value perhaps in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt because subject to just very high levels of uncertainty.
Brian.
Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what that's all about, but I'll tell you what I think and what we see in surveys, and that is, there were big price increases all around the world, by the way, everywhere in countries like the United States had basically the same kind of thing. It was a global inflation coming out of the pandemic, and everywhere people are feeling like real wages have been going up in the United States now for 3 years, roughly. But people are not feeling good about it yet. And it will take some years of positive, real earning gains for people to feel good again, we think. But you're right. But when you talk to people, they do feel squeezed. And, there are areas where prices are still going up, like insurance. Various different kinds of insurance are getting more and more expensive. And that's just catching up really from inflationary pressures that take a while to get to into the price. So we take it very seriously. We don't dismiss it at all. It's a very real thing from the standpoint of what people are experiencing. And what it does for us is, makes us even more committed, if that's possible, to getting inflation back to 2% on a sustained basis.
How does the Fed's independence play into the ability to address affordability?
Well, independence is what allows us to do our jobs. And, stable prices is half of our mandate. It's one of our two mandates, maximum employment being the other. I mean, look at every advanced economy that looks anything like the United States, anywhere in the world, in a market economy, in a democracy, and you'll see, pretty much central bank independence that looks a lot like, in some cases, stronger than what we have. But it's critical that we have that so that we can do the things when we need to do them to preserve price stability. And it's an accepted standard practice, and I think has a lot of support, certainly in Congress, which is where our oversight is in Congress. And you see that among Democrats and Republicans in the House and the Senate.
Richard.
Hi, Chair Powell. Richard Escobedo at CBS News. Thanks for doing this. Two questions. One, how high would oil prices and broader inflation have to go, and for how long, for the committee to consider hiking rates? And then secondly, diesel prices are rising faster than gas prices. How concerned are you that the increase in diesel might drive up food and goods prices and lead to broader inflation?
Yeah, I'm not going to give you an example or specific answer on the first question. We're prepared to do what needs to be done, but I wouldn't want to hypothesize about what that might be. In terms of diesel prices. So your question there is, are we concerned about it? I mean,
how concerned, and whether or not it will drive up, the cost of food and other goods that really rely on it to.
So I think it's a more general concern than that. It's diesel prices because that's transportation of food and things like that. There are just lots of ways that oil and derivatives of oil get into the production and transportation of many, many things. So, and those, there are big effects in headline inflation, but things like that leak into core as well. And the effects may not be as big, but they're quite real and they're material. So we are aware of that and we're watching it, but we're right at the beginning of this, and we don't know how big you just don't know how big this will be and how long it lasts. It may or may not be something that really makes a big imprint on the U.S. economy. We're just going to have to wait and see.
Thank you.
Archie, for the last question.
Thanks very much. Just to sort of stare into the future for a little bit, I was looking at the longer run bits of the SEP and noticed that the growth estimate had been revised up a good chunk from 1.8 to 2, and the kind of long-term Fed funds rate as well. It'd be great just to hear, is that AI productivity or what's going on there exactly?
Yeah, I think it's just productivity. We actually started seeing meaningfully higher productivity some years ago, 4 years ago, 5 years ago, and that's not because of generative AI. We won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity. And by the way, I expect it to continue. And we haven't really started to see the effects of generative AI. And that should certainly contribute to that. So it's quite unusual. And it's this is the higher productivity is the thing that allows incomes to rise over time. And so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that. And just briefly on that as well to finish up, you hear the argument a lot, this is a sort of disinflationary story. And if you believe that productivity thing, that should also weigh down on inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates?
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really what is the demand growing faster or slower than the supply side. And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Okay. That was crazy at the end there. Periods of high productivity are often so rare and often revised away. That's some anti-AI commentary right there to end it. All right, bye guys. Leaves the market down 1%. But I mean, overall, the actual statement of no rate changes and stuff like this is more of a message, at least for me, than some of his commentary in the press release. But I'll keep an eye on this. So the Qatar LNG operations being disrupted after attacks linked to Iran. Let's see. Qatar Energy has evacuated its Ras Laffan, I can never say that, LNG terminal after confirmed missile strikes around the facility. Supposedly the fire is under control, but yeah, it's going to definitely hurt. VG as a stock is actually booming on this news. $14.27 during the day. Tanner, are you listening to sports in the background? You think I listen to sports? No, sir. No, sir. Okay. So we have roughly about 40 minutes until the market close. There's still some more news that I want to cover. I also want to listen to Chairman Paul Atkins regarding crypto prices as well. There's a lot to cover there. Let's see what else. There was also a Disney commentary video that I also wanted to check out. Future of Disney looks like it's going to change. I mean, everything that comes out is always regarding artificial intelligence, but yeah. Okay, so we'll check out the full interview with Paul Atkins here in a minute, but you know what's so funny? Tanner's watching the Champions League. Do you guys want to know how much I don't know sport? I don't even know what sport that is. Most times whenever I hear league, I think it's soccer, or if you're European or whatever, football. But like, I have no clue even what Champions League is. That's how much I don't care about sports. Cricket. Got you. You're probably into pickleball. Okay, Dylan, you've been watching for a long time. So you're acting like you don't know, but you probably do know that I'm into pickleball. If that was a guess and I come off as a pickleball guy, then yeah, you called me out pretty good. But yeah, I definitely do enjoy some pickleball, that's for sure. I'm running up and down that court. Hood's social beta is out. That is correct. And in fact, I received an invite. However, I'm not an American. So I was at the Hood Summit last fall, but I have no account. So I'm not an American. But yeah, 1,000 people to start posting. Be kind of quiet on a social media platform with 1,000 people, but overall, we'll have to see how this evolves. Could be quite interesting. There's so much stuff that they could do with a social platform. Copy trading solutions, verified trades, all of this stuff. I think it's great. The only problem that I have is I know a lot of people with a lot of money. And while they would like their trades to be verifiable, even via a percentage of their portfolio, they do not want their actual amount of money to be out there. You know, Tanner. I can't talk today. Oh my gosh, we have so much more stream to go. Okay. But Amit, for example, right? Like Amit would like to share trades and can prove, like verify that a trade actually did happen. And they say, hey, you know what? I've got 10% of my portfolio in X or in this company or in, whatever. But he's not wanting to essentially let people know how much money he might have, because that could lead to potentially bad things. Pickleball is for loser tennis players. Well, I've never played actual tennis, so I don't know. Maybe I would love tennis, because I love pickleball. I don't even remember who got me to a pickleball court, but whoever did had sealed my fate of being a pickle boy. Yeah. Tanner, be my friend. I'm friends with everyone here. If you're in the chat and you're part of the future investing cult, then we're already friends. Okay. Google Cloud will be amongst the first to offer NVIDIA Vera Rubin systems. Timeline is expected as early as second half of 2026. I mean, we're approaching that pretty quickly here. Got about another quarter to go. This puts Alphabet right at the front of next-gen AI infrastructure rollouts, along with Nebius and Microsoft and a bunch of other, top-of-the-line companies as well. Google then also had a report talking about meeting with Pentagon's Undersecretary for the Department of War. So curious if they are wanting to help with their AI services, cloud services for some significant government contracts could lead to new revenues, as well as having things like Wiz, their cybersecurity cloud platform, could be amazing for the for government contracts to hopefully make a lot of money. We will see what happens with that. We have Micron, DLocal, Red Cat. What else? Red Cat after earnings. Five Below. Those are really the main four for tonight. We'll be covering all of those. Yeah. Tanner, be my friend. I don't have Robinhood. I'm a Canadian, guys. I can't even use the services that I'm investing in. Now people go, how do you do that? And it's like, well, how are you buying NVIDIA's chips excited for Vera Rubin NVL72s? You know? How are you guys buying Palantir? You guys telling me you're all a part of the Department of War? Everyone always gets so offended whenever I say, like, oh, I'm buying into companies where I don't use their products. I'm like, wait, so you've never... Well, of course I've seen it. I look at all the demos online. Canada doesn't even have online brokers. They still have to call to make their trades. Yeah, but they're on speed dial, so I can make it pretty quick. Okay. Let's listen to Chairman Paul Atkins. I really want to hear about some of the changes through crypto. And then obviously we have the market close and Micron after. Micron's at 4:30, by the way. So if you guys don't want to listen to this call or whatever, or the Paul Atkins thing or whatever, don't return back at 5 to listen to Micron. Micron is early. It's at 4:30. Okay? And we'll get the numbers at 4 o'clock. Let's have a listen. When's Wealth Simple IPO? No idea. I'm pretty sure they're majority owned by Power Corporation. But, yeah.
The SEC clarifying its position on crypto assets, interpreting digital commodities, digital collectibles, digital tools, and stablecoins not to be securities. The SEC Chairman Paul Atkins joins us live from Washington this morning. This is a pivot of sorts. Help us understand, and we'll probably get into the weeds of it all in terms of just the mechanism for all of this, but how you landed on this decision and what it means.
Oh, well, thank you, Andrew. It's great to see you again. And this follows up on some of our prior conversations about this and other topics when you've been gracious enough to have me on your show. So thank you very much. But first of all, yes, yesterday was a real break with the past, a formal break. The Commission came out for the first time with an interpretative release that really sets a line between what are commodities in the digital asset space and what are securities. And the significance also about this particular release that we did is that the CFTC participated with us in it. And so they had some guidance that's included in that release along with our interpretation. So basically, as you said, and that tripped off your tongue very well, so it's very good, we are outlining 4 types of assets that are not securities. And those are digital commodities, digital tools, digital collectibles, and stable coins. And stable coins per the Genius Act that was enacted last year. So we're breaking with the past. We are now giving clarity from the SEC's perspective as to what are and are not securities.
Okay, so it's funny, as I was looking through the list, the one I wanted to actually focus on, oddly enough, was digital collectibles, because I could see how a digital collectible, perhaps more than the other 3, could be considered a security depending on how it's structured.
Well, that's true with anything. And so this is also what this interpretation lays out, is we're looking at, there's an old case from 1946 before the Supreme Court. It was called SEC versus Howey, and it had to do about orange groves and that sort of thing. But today, obviously with digital assets, those principles apply. But what we are focusing on is what makes an investment contract, which means what makes a security. And we're focusing on the promises and the representations that the people who are constructing it make to their purchasers, their investors. And so some of these collectibles, like a baseball card, an equivalent, a meme, one of these meme coins, or things like that, NFTs, non-fungible tokens, those are something that somebody buys. It's an immutable purchase that someone has given, and the token is what's set aside and collected, and it's not something like another asset where people are trading it, and there's an ecosystem around that.
So what, just to define it for the audience, what is a digital security then in your mind, which you would regulate?
Well, digital security goes back to what is an investment contract, and that is a set of promises that the developer of that particular instrument has made to investors as to how it will be managed and what what rights they have to that particular in that particular investment contract, and how they expect to make money off of it. So it's more than just something that is sold as a thing to hold or collect. It's more than a tool, like a ticket or something like that, a secondary ticket for a box office or whatever. And
what happens if let me ask you this, just because this may be the future, or people talk about it being the future. You buy a digital ticket or a digital card that is a collectible, but also 10% of it gives you some kind of stake in the future of the business as well. Is now that a security all of a sudden?
Well, so you're talking about there are things that are somebody's putting money into an investment that is an ongoing enterprise where people are supporting that and managing it. So this a facts and circumstances case. What we have done is set out all sorts of examples in this particular interpretative release, and setting up a process and a framework by which people can have certainty. Their lawyers can give them an opinion. They can come in and talk to us about things if they are unclear. And unlike in the past, they won't then go home after they've talked to the SEC and find a subpoena on their doorstep or something like that. Right. So we're setting up a framework. This is just an interpretation, and so courts can deviate from that, of course, if they don't like our rationale. But what we're also going to follow up with here shortly is a proposed rule that will put a lot of this into effect and be much more specific, construct a series of exemptions and equivalent of a sandbox for people to do experimentation to see if they can develop a proof of concept and then go forward with what their product might be.
Let me ask you about a headline that I know a lot of corporate leaders, investors around the country and the world are thinking about right now that relates to what you're working on, which is the idea of changing the disclosure requirements for corporations from quarterly public disclosures to at least allowing companies to only do this twice a year. Where are you on that plan?
Well, Andrew, this is something that you and I have talked about before. It was last year, I guess, right here on the show. But so we're planning to come up with a proposed rule and collect comment on this as to the cadence of reporting for companies. Now, when you look at our whole system of quarterly reporting, that's relatively new. That came about in 1970. Back when the SEC started back in 1934, the SEC basically adopted the New York Stock Exchange rulebook in many cases, and among which was annual reporting. And then back in 1955, it changed to semi-annual reporting. And in 1970, it went to quarterly reporting. So I'm agnostic about this. Frankly, I'm looking forward to the discussion, debate, and the comments that will come in. But suffice it to say, investors will, have comments, I'm sure. And it probably depends a lot on the nature of the company. The UK followed us with respect to this whole cadence of reporting, including quarterly reporting. But then about a decade or so ago, a dozen years, they switched from the quarterly reporting back to semi-annual. So we already have now foreign private issuers that our stock is being traded on the New York Stock Exchange and NASDAQ and elsewhere where there is semi-annual reporting.
Right.
So
I get the argument around sort of, trying to get rid of some of the red tape. We talked about trying to make IPOs great again, trying to make public companies companies want to be public companies. On the other side, I think to myself, at least historically, some of the kinds of companies that have run into trouble over the years, if in fact they didn't have to disclose some of these problems, they could have built up even larger, frankly, if they had 6 months rather than 4 or 3 rather for those problems to emerge.
Well, there's a lot of cost and infrastructure that one has to build around reporting. It's not just something that you just kind of press a button on the printer and churn out with that meticulous review and everything else, such as the way the markets are working these days. So for smaller companies, maybe it makes more sense to have it semi-annual. Maybe analysts will follow smaller companies if there's less of a cadence. People even now focus more on the earnings calls that are done by the CEOs and CFOs of companies rather than necessarily the 10Q. So I think there are all sorts of different aspects out there that we should. I think it's high time for us after 50 some years to ask the question and see what people say, and then let's work together and figure out what makes the most sense. But probably flexibility, is one of those aspects that could be like the UK does. That could.
Do you imagine the flexibility cuts across all companies of every size? Do you say to yourself that you'd prefer? It's very interesting dynamic. On one end, you're right. Maybe for smaller companies, it would save them some money and make it more attractive to be public. On the other end, sometimes more of the frauds and other kinds of complicated things happen amid some of the smaller companies. Also, some of those smaller companies, I think, oftentimes get attention for putting out quarterly disclosures, and they need the attention on one end. You're also making the flip side argument, which is that certain analysts don't cover companies because of the work involved in tracking. And I don't know whether it would cost people more to track it. Track it quarterly versus biannually.
Well, you can even, one CEO mentioned to me, pointed out that, of course, he gets monthly numbers, internal numbers. So he was saying, well, maybe it's best for us to do monthly reporting. Now, that would be probably for most companies create a lot of heartburn. But, if this all will translates into what the cost of capital is for the company, and if they find that they get more traction with analysts and with others, if it's more frequent, then that's great. If it's better for the company,
right. So
we'll see. We're going to be asking all these questions, and I look forward to your input as well, and and others. So
it's a fascinating one. I have one other question for you, because we've been talking about it now for several weeks. There's a real, we've called it a freak out here on the show, but concern about the private credit market. And the reason I'm raising it with you is the private credit market is not just private anymore. In some ways, it's public. And there's a question, I think, more broadly about these sort of either private credit, maybe even private equity, that's now living in a public wrapper, if you will, that is reliant on marks, meaning valuation work that's done ultimately by the companies themselves, not the markets determining what the actual value of either the underlying equities or the underlying credit is. And I'm curious, because there's a question mark out there about how accurate the marks, if you will, are these days, and whether you have a concern about them.
Well, these particular investments, obviously it's private, so there's not a public market in these investments. So to come up with a valuation, one has to look at comparables in the marketplace, just like if you're valuing your house or whatever. Your house isn't for sale yet, and so there'd be no bids or offers on it. And so that is one way of that's the way that someone has to go about to try to value these sorts of securities. So that always has a element of estimation in it, and so that's why there has to be a rigorous process. The quality, the credit quality matters a lot. So we are working, of course, with the Department of Labor and Treasury on the prospect of opening up some of these types of investments to other investors beyond accredited investors. But this is one thing I've been talking about from the beginning. Valuation is extremely important, fees, and someone can't just go blundering into this particular marketplace without having a plan and advice and understanding what one is doing. So the way we're approaching this is in a very deliberative manner and working with the Treasury and the Department of Labor to try to come up with a good framework.
Hey, Paul, I have one final one for you. It's not your business, it's really the CFTC to some degree, but I'm curious just more broadly how you think about it, which is we're living in a world now of all of these prediction markets, sort of a new world of trading, if you will. And I'm curious whether just you look at that just on a personal level and say, this is great for the country, great for society, or not. I think there's a real wide debate about this right now.
Yeah, well, so I agree with you. I mean, I think there are always pros and cons, but my colleague, Mike Seelig, who's the chairman of the CFTC now, he makes a good point about this is a democratization of some of these markets, and often that provides a lot better information than other more traditional ways of polling or whatever. So I think these prediction markets, are very interesting and exciting. There are some that fall into our ambit of oversight if it has to do with what's underlying it, a question about security. But we're working again with the CFTC to try to clarify all this and make sure that people have a sound basis upon which to develop their product.
Okay. Yeah, I honestly think they touched on the multiple different, whether you're going to have quarterly reporting, monthly, twice a year, something like this. I honestly think the way that I would think is best, because it definitely is a large expense for extremely small companies. But if you're above $10 billion or even something like this, you should have to do quarterly because it doesn't make that much of a difference on your, G&A expenses. But also it does add transparency. And so this idea that like companies can think longer term, it's like, bro, you can think longer term now. Like it's arbitrary that you have to think short term because you're reporting on a quarterly basis. Companies that are cyclical, e-commerce companies, advertisements, everyone knows that December is going to be the strongest quarter. They don't try to flatten out that curve. They just try their best across the year to do well. And everyone knows that December is going to be strong and it's going to be slightly lower the quarter after that. And like Costco, Nubank, like there's countless businesses that focus on the long term and not on the quarterly basis. And you just have to, you as the CEO have to deliver that message saying, hey, guys, if it's going to be weak for a quarter, get over it. What? So now every company is just going to focus on 6-month targets rather than quarterly targets? That's going to make a difference. I'll cover DLO earnings numbers. We will not be listening to the call. I'll be listening to that afterwards, but on my own. That's going to be a sauna listen for sure. Next decade is up 16.3%, nearly $7 a share. It had passed $7, but it is being extremely volatile. Same thing for Venture Global, also up 15%. These names are absolutely exploding. Maybe I shouldn't use that type of language. Maybe they are going up. Okay. Due to other LNGs exploding. True shame. Hopefully no one's hurt. NVIDIA down 0.6%, $180 a share. Just constantly at this price right now. We have Micron about to go into earnings 15 minutes out. Is up 0.8, and then SanDisk I saw had hit a new all-time high today, up 4.7%. NAND doing well, but it's DRAM's day today, and Micron will do well. Well, I mean, I can't say it'll do well, but I hope that commentary is good and that guidance blows people's minds away. Meta announces they're shutting down the metaverse after pouring $80 billion into the project. Is that true? I definitely did not see that. I'm not saying that's not true. I mean, but I didn't see that they're shutting it down. I definitely heard that they're moving some resources, but that has not appeared on my screen. So we'll see. Where is it? Not a good day to report earnings. I think it's okay. It happens. When is a good time during this market right now to report earnings? We're in extreme fear. We've kind of been here for a little bit. Like, you know, the show must go on. Could you imagine, though, if you only had to report every 6 months and like the one time that you had to report earnings was on like a catastrophic day, like a Black Tuesday or something like this, and that was the day that you had earnings? Oh my gosh, that would hurt. Okay. Yeah, where is the fear and greed index really quickly? Fear and greed, last time I saw it was oh wow. We're under 20, ladies and gentlemen. 19 on the fear and greed index, 19 days into the Iran war. Coincidence? I think not. The Incredibles. All right, somebody got that reference. Damn, I just created my metaverse avatar today. I don't know if that's true just yet. I have not seen any report on that just yet. Yeah. Traffic through the Hormuz Strait is coming back now at 25% of pre-war levels. We'll come back at full speed soon. Mainly outbound shipping. Oil price per barrel today, we're trading at low of 91, lowest since March 6th. Is that even true? That is not the lowest since March 6th. Yeah, I mean, we had lower prices than that. I think they're looking at a really zoomed out version, but those aren't actually, this is not showing the lows. But we had lower pricing than that, you know, recently. All right. Okay, but currently at $98.52 right now, crude oil up 2.8%. Tevis and Tanner Toronto meetup is in August, but I'm waiting for Marshall to come aboard. He's going to help me find a venue, set it all up, make sure we have ticketing and all that stuff. Good earnings could pump Micron after this flush or more pain. So the thing with Micron is it can be a definite cyclical business. So they cannot beat by a little bit. Guidance and the trade that I'm hoping for is that I'm looking for a double-digit beat on guidance. Nothing small here. I'm not playing with. I'm not planning for a small move. Okay, I need a big move here. That's the expectation on the change on my the memory prices and then the expansion of the market through the next quarter. Some potential commentary throughout the rest of the year and commentary on the markets would also be very appreciated. But we'll listen to that call today. Please say something encouraging about SoFi. Honestly, what's so funny is I think it's getting dragged down by a bunch of companies that are not in the same sector. Well, not in the same sector, but in the same space of the same sector. So it's getting dragged down because Block and Affirm and Klarna are showing that they might have, loan sales that are underperforming expectations, but none of those companies end up dealing with high-end customer credit. Then there was another thing that was blowing up in private credit, but that was software names, commercial loans. So look, we haven't seen a consumer loan, high-end credit end up blowing up just yet. And so SoFi's catching strays left and right, and that's perfectly okay. I'm not actually worried about it. But as long as sentiment doesn't become fundamental, I don't worry. I'm shorting Micron. Dookie. How could you do this to me? Why are you sealing my fate like this? We will see. SPY is now flat for 6 months. Dookie's messing with my emotions. VG about to be $15 a share. 15. Could be quite nice. Also, someone said that SoFi USD is seeing activity, and it actually is. I just checked. I have it on Etherscan here. We're now at 10 million total supply. We're starting to see some things come in from an hour ago, 25 hours ago, 2 days ago. The ETH supply or the SoFi USD supply is now at $10 million. It was at 7 million before, and then they ended up removing that. So we'll have to see if they're still like testing it or what's happening. We're obviously not seeing a consistent amount of inflows and outflows. Like it's not live just yet. Doesn't look like that yet, but we'll see. If you flip your monitor, the lines don't look so bad. So true. Well, if I flip my monitor, it makes VG look like it's down and to the left. It's up and to the right, ladies and gentlemen. Next is doing very well. I know it is. About to hit all-time highs here. Well, sorry, not all-time highs, but testing recent highs. $7 local highs. Okay. Tanner fixed the pain. I'm a viewer. I'm a viewer of the markets. I'm with you guys here. Let's call Stevie Wonder and see what he has to say. If he answers. Yo, I'm live.
Of course you are. You're unbanned.
I'm unbanned. I'm live. I was getting ready for our chat, but I wanted to talk a little early.
You wanted to talk a little early, you say.
Yeah. What the heck is going on right now, man? Market's down. Rates remain unmoved. Are you watching any of this?
No, I was in a meeting, and I know the market's down. I did not listen to what Powell said. I'm going to assume he was hawkish. I'm going to assume he was saying oil is unpredictable. It could be higher for longer, which could impact the Fed, blah, 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 blah.
Dookie said that you slipped up and you told her that I don't like her. What's that about?
What do you mean?
Dookie Pie in chat said that she said that Steve said that Tanner doesn't like her.
Yeah, that's factually not correct.
I knew it. I was like, that's an impossibility that Steve said anything along those lines.
Factually incorrect, sir. I am sure that Dookie mistyped that.
No, she did not. Dookie, what do you have to say for yourself? She's also, I said that I'm swing trading Micron right now. She said LOL.
What do you know about swing trading?
I'm learning new. Old dogs can learn new tricks.
Okay. All right. I think Dookie just likes causing trouble.
Yeah, she just said I like to tease.
Yeah, she's having fun. That's all.
Yeah. But I said that I'm going long on Micron for these earnings, and she said that she's shorting it. Who do you have money on?
I mean,
Steve, I've been your pal for a long time.
Listen, we talked about this yesterday for quite some time. The stock is so cheap on a fundamental level. Today just may not be the right day for them to report just because of what's happening in the market and what's happening with the Fed. They could very easily go up by $50. They could very easily go down by 50. I mean, if they raise guidance, I don't know how much cheaper this stock can get, to be honest with you.
What if they raise guidance by like 50%?
If they raise guidance, this thing could shoot up over the next week or two by 100. But they got to raise guidance, and it's got to make the multiple compress to where it makes sense to buy it up. I mean, trades at 12 times earnings.
Forward earnings,
It's
you mean?
incredibly cheap. Yeah.
Yeah.
2026 earnings. It trades at 12 times.
Yeah.
It's cheap.
We will see. I'm excited to listen, but the market's about to close here in a couple minutes. What is? Oh, you don't really follow DLocal, eh? No. Okay.
I mean, everything's down. Nvidia's down. I was thinking about buying more Nvidia.
Not everything, dude.
Today.
VG is up 15%. It's $15 a share right now.
Yeah, energy's doing well. What's next doing? Next is probably up
Next,
also, right?
next is $7 up.
17%. What the fuck?
Whoa, buddy! This is a friendly channel.
There's no such thing. I'm shocked. Next decade is up $1 today.
So supposedly, I can't say it. The Rafin, something like that. Qatar's LNG plant or something like this facility ended up getting bombed.
Okay.
So there is a little bit of a catalyst, not a good one. Qatar Energy just confirmed strikes caused extensive damage on the Ras Laffan, which has about 20% of the world's LNG come from it.
Huh?
All right.
I mean,
I will let you go. I've got the market close here in 60 seconds. So pray for me. I've got DLocal and Micron. But more importantly, I think Micron might spell some potentially good or bad news for all the hyperscalers, neo clouds, NVIDIAs of the world.
Are you live right now because it's not live?
No, I'm live because of FOMC, mainly Micron earnings.
Gotcha.
My main live stream, stuff like that.
Okay.
And I think Mitt was live, actually.
Oh, I don't know. All right. Well, you have fun. I'm rooting for you on Micron. I'd like to see it go up, and I'd like to see them have good guidance because that would be bullish in NVIDIA. So I got to root for Micron on this one.
Thanks, brother.
I'll see you at 8 o'clock.
Yeah, see you. Bye.
Later.
The Qs are down 1.4%. What the heck? What a bloody day. Let's drop the chat really quick. We got to focus up. The numbers are about to come in hot. I'll hide this for a second. And here we go. 20 seconds. And the market's about to close. We have Red Cat reporting earnings. We have DLocal reporting earnings. We have Micron reporting earnings. What else do we have? We'll follow the cues. We'll follow the SPY. The market is now closed. Ladies and gentlemen, let's jump over into the companies that we know and love. Let's follow Micron really quickly. Ended up closing flat on the day. I mean, does Dookie Pie get it right or do I get it right? Well, honestly, it'll be different on what the actual result on the numbers are and then what it's going to be the weeks after. Because the time that they showed off their extremely impressive report here, you can see the earnings right there. It didn't even move that much. But then over the course of the next little bit, people really started to price in what it meant. So I do worry that some of that could happen this earnings. And right now, it's up 0.3%, but really just sold off right before earnings. So, we're green. Are we green? Are we going to stay green? Up 2.8, up 3% on Micron. Micron's earnings are out. Oh my God. I knew it. Revenue beat by 22%, EPS beat by 40%. Revenue went up 200% year over year, EPS beat by 682%. That's why we swing trade those days, baby. That's why. Massive, massive beat. This is going to be a good day. The stock, I don't get Micron. This is so funny to me that this company does not move on earnings day. It's like this should be up 10% right now. This should be up 10% right now. You beat revenue by 22%. That simply does not happen. DLocal up 2%. And did I get a double day? Let's see if we got a double day. 5 below, double beat on that name. Where's 5? Up 2%. Where's DLocal? Come on, DLocal. Let's see when DLocal is supposed to report earnings. DLocal is supposed to be out. It's expected to be out. It is, dude, it is so rare to see beats that big. It's insane. 22% revenue beat, 40% EPS beat. That's after really, really bringing up expectations. Stock's up 1%. This is what happened last time. I think it's going to move. Top line revenue was 23.8 billion. Expectations were 19.9 billion. EPS, $12, adjusted EPS, $12.20 versus $9.20 expected. That is huge. Net income, 13.8 billion, adjusted net income, 14.02 billion. Oh my God. I said this. What did I say? If Outlook beats by 50%, that's exactly what happened. Q3 revenue, 23 billion expected. What they actually saw, 33.5 billion. That's roughly a 50% beat. Exactly what I said. EPS, 18.9. Adjusted EPS, 19.50 cents versus 11.70 expected. 19 versus 11 expected. There is a massive, massive memory crunch right now. Massive. You're saying, what's the margin? The earnings beat by 40% and top line beat by 22%, means that there is a massive margin expansion. The margins are fat. Let's get the earnings, but give us a second. Okay. Where is Micron? Dude. Ugh. Literally, I don't even feel this good buying companies and holding them long term. I get why people trade now. This is the best feeling of all time. This was all priced in as the funniest thing I've ever seen. This is literally what happened last time. The stock didn't move. And then it ended up going from 250 up to 450. It will move. We have to give it time, but this thing will move. I guarantee it. The memory crunch is so strong with this one. It will move. I'm confident. Usually the good feelings of trading come when you take profits. I'm counting my chickens before they hatch today. That's what's about to happen. What, are we negative? Are we negative? Dookie, stop calling people and telling them to sell. Well, how are we negative? We got $19 of EPS versus 11 expected for guidance. 50% beat. Who's Dookie calling right now? Dookie, enough. Time to close your short and go long, baby. It's time. Okay. Let's see if I can get their presentation. I don't see their earnings presentation just yet. And by the way, oh my God, their thing is terrible. I also have not gotten DLocal's earnings yet either. Red Cat missed EPS. Red Cat missed EPS by 13%. Revenue beat by 10%. Nice. And DLocal. I cannot get over these numbers. The only number that even remotely missed was adjusted operating expenses, and it missed by like a percentage of a number. Commentary from the CEO. Micron set new records across revenue, gross margin, EPS, and free cash flow in fiscal Q2, driven by a strong demand environment, tight industry supply, and our strong execution. And we expect significant records again in fiscal Q3. In the AI era, memory has become a strategic asset for our customers, and we are investing in the global manufacturing footprint to support their growing demand. Reflecting confidence in the sustained strength of our business, our board has approved a 30% increase in our quarterly dividend. This is a dividend name now. EPS of $19.50 for Q3, and that was above expectations of $11. That's the type of day that we just got. Stock is down. I know you guys said, I did play Micron Earnings. I know you guys said like it's not a good day to report, but this is crazy. We still have the call, but this is crazy. Micron's website cannot be reached right now. The website is temporarily down right now. Are this many people going to... What is going on? Okay, let's go back. Little refresh. No, we're Micron stock website is down. Can someone, if someone else has it up, can you guys send me the presentation, please? I would love to read through it. Mine is down. Literally the printing some green, baby. I'm sure this is where Dookie turned positive, I think. We're back to being green in the after hours. DLocal up 1.4%. I still don't have any numbers on DLocal. However, the numbers are supposed to be out. Let's try to bring up the website. I'm also going to try to bring up Fiscal AI, see if they have these numbers first as well. They're usually pretty fast with it, but not yet. Micron back up 1.2 or 1.3%. Oh, I don't know if that was good or bad for my heart. That was... It seriously needs to be above 10% right now. That is so unbelievably above expectations. It's crazy. Okay. Priced in my beep. I freaking this company is going to be trading at like okay, so if before they were trading at 12 times, they just beat this quarter by 50%, that alone almost brings it down to 10 times in itself, let alone the expectations of the continued next 4 quarters that are going to end up being raised. I bet you this company's trading at 9-8 times forward earnings. It, like, what are we talking about? What are we talking about, ladies and gentlemen? Okay. Nothing's working. Websites are down. Investors at Micron.com is down. Am I for real? I know this is like one of those things whenever someone says, like, help, help, help. Everyone thinks that, you know, it's time to put their phones down and someone else is going to do it. No, no, no. I'm talking directly to you. I need your help. Send me the presentation. You. Literally you. Send me the presentation on X. Don't wait. Not someone else is going to do it. You need to do it. I have my message requests open right now, and I'm waiting. My thing is down. Okay. Everyone's just watching me, the poor lady, get robbed here, and they're recording it, and they want to, they want another hero to step in. It's your turn. Okay? Ask Marshall. He's not on the team yet, guys. But it will be nice for him to send me this report. You're right. I'm emotionally stressed. Look at this. Look at this. This is Stock Market Nerd. So I want to give him full credit, but I also want to zoom in. So this is Brad Freeman, Stock Market Nerd. He's the GOAT. He always puts together these one-page reports. Okay? Crushed revenue estimates by 22.6% and crushed guidance by 27.8%. Crushed 69% gross profit margin estimates by 590 basis points. That's 5.9%, and then crushed guides by 6.9%. Crushed operating income estimates by 40% and crushed the guide by 46%. DLocal. Guys, it's the most wonderful time of the year. Dancing and singing and DLocal's here. I'm up nearly 8.3%. And who didn't say it's Christmas time? Okay, it's March and it's snowing. And did you guys see that red candle there for a second? Oh, okay, it's gone. Whew, it's the most. I know Doogie Pie just has the amount of money needed to change the aspect of this live stream to just come in here and short this company. You need to not, okay? I need a win today. Give me one win. Give me one win. Anyway, let's go back to Q3 guide. He has it a little bit mistaken, I think, but still, the estimates are still true. Revenue guide crushed estimates by 44%. 81% gross profit margin crushed 71% estimates. You're guiding for 81%? And we're not up. We're up 0.9%. What are we talking about? I don't know. $19.50 EPS guide crushed the $11.70 estimates. Have you ever seen something so beautiful? Wow. And what I love, it should actually be it should be mandatory that people end up doing the earnings at 4:30 and not 4:15. Okay. I have the trading bug. I get it. Are earnings out? Earnings are out. It's so funny. Like literally a second ago, we had the earnings on screen and people are like, are they out? Yes, they're out. It was a devastating crush. Devastatingly good. Okay, I have DLocal's numbers. They beat on revenue by 14%. Revenue increased 65% year over year. It's so funny. They beat revenue by 14%. That is so unbelievable. And yet I'm like, well, it wasn't Micron. You know? But it's like earnings can be very, very different than what people expect because you can always tighten expectations, have tax burdens. Like there's so many ways to have big surprises on EPS. So don't get worried or overly surprised if a company ends up showing EPS that's higher than expected. Revenue, because there's so many channel checks now, it's so hard to have even a 5% beat on revenue is huge. A 10% beat on revenue is unbelievable. 14% beat on revenue, which is what DLocal just showed off, is amazing, and that's why we're seeing a pop. Micron beat by 22% and expand EPS by 40%, and the stock hasn't moved. Wonderful time. All right. Still, I'm a happy camper. Okay. Let's try. I saw somebody send me something on Discord. Somebody sent me the report. Haribo ended up sending me the earnings deck for Micron. Yep. If you're Haribo, if you're in chat, please say it was me. Twitch, YouTube, I don't care where it is, you're getting modded right now. Everyone watched the fat lady get robbed. Caleb also sent it to me. Caleb, thank you. You're already modded though. But yeah. Thank you, Haribo. I actually am going to mod you right now. Boy gets a wrench for that. Or girl. But I'm just going off of, demographics right now. 89% chance that you're male right now in this chat. We're making excellent progress of ramping our industry-leading 1 gamma DRAM and G9 NAND technology nodes. We expect 1Y to become the highest volume node in Micron's history. I don't know anything about this space. I'm simply doing this as a trade to know about the supply crunch. Revenue up 75% quarter over quarter. Normal. And up 196%. And then a bunch of people in chat were like, yeah, it's priced in. DRAM was $18.8 billion, representing 79% of total revenue in fiscal quarter 2, 2026. Revenue increased 207% year over year, and revenue increased 74% quarter over quarter. Bit shipments up mid-single digits quarter over quarter. Okay. Dun, 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 here. 74.9% gross margins. I could cry. DLocal's up 11.8%. And Micron is practically flat. Gross margins approximately 81%. Revenue $33.5 billion plus or minus $750 million. Unreal. It's always so funny whenever they're like 19.5 plus or minus 40 cents. It's like, dude, last quarter you said it was going to be like $11. Not plus or minus 40 cents. It was plus or minus dollars. Okay. And the call is in 9 minutes. We have time after. Remember, last time the stock was only up 5% after they beat by like an ungodly amount. And then over the next couple weeks, the stock had ended up running up essentially up $200 a share. Some crazy things are going to happen tomorrow in the market. Some stocks are going to make people very, very rich. Am I one of those people, Dookie? Or do I... Tanner, now that you've made a lot of money, you should give out free memberships. I don't have free memberships. They're not free. I'd just be giving myself money. I'm giving Google money. The memberships don't do... By the way, the memberships don't do anything. Just make your name green. The content's already free, ladies and gentlemen. If this is what you wanted from me, just to panic while the stock does not move, then you got it. I need to blow my nose so badly. Give me 1 second. We're back. Look at this. Look at this. Turn off my camera for 1 second. Okay. NVIDIA, 180.20 cents right now. I don't know why it does this. I want it to like stick. Sometimes the price adjusts. I don't know if there's a setting or something. I don't know why it does that to me. Five Below is up 5%. DLocal is up 10%. And let's get DLocal's thing. I tried to get it up earlier, but it was not appearing for me. It's not on Fiscal just yet. That's what I do need. I need Micron on Fiscal AI now. Okay, it is up. Oh my, dude, look at this. This is what I was betting on. Now people saw this coming, but remember, this beat by 22%. So they did not think it was going to be this good. Okay, this is revenue on Micron, and this is the revenue change. Then look at what they're calling for. This is what Wall Street, this is what people are saying is priced in. Give your head a shake. Okay, next quarter they're saying 23 billion currently is Wall Street's expectation. We just saw that Micron said the number's actually going to be somewhere around 33.5 billion. So they're going to have to price this guidance up way above this line in the chart. They're going to have to rechange the, axis to adjust to allow how big this chart is going to go. And you think that's priced in? Look at where Wall Street is expecting. You can see it right here. They're expecting no growth. None. We're about to skyrocket. Next quarter is expected to be $33.5 billion. Too much good news syndrome? I don't know about that syndrome, but honestly, I'm feeling it right now. I honestly think they don't believe that any of this is real. And they don't believe that the AI trade is going to continue at this rate. I think we have 9 more months of the memory being really, really supply constrained because there's no clean room space. People don't realize this. There's no clean room space to even like produce more memory. So while there's more chip purchases, there's not like you can't ramp up the like manufacturing of the memory space. So they're acquiring and building clean space as fast as possible, but this takes years. Okay. So Micron just ended up acquiring another business in Taiwan to end up giving them essentially an additional 300,000 square feet of fabrication space, but it doesn't come into production till fiscal 2028. It's where I feel like Chicken Little here. Like I'm screaming, the sky is falling, the sky is falling. And we're really going to have a memory crunch. But the only thing falling is Micron's stock price right now. All right. We don't need clean rooms in space. We need clean rooms anywhere, and they're not appearing. All right. So buy share. I will most likely buy share. Okay. Let's listen to the call. Things can change. Oh, where's my phone? I will buy shares. Okay. The call starts in 3 minutes. I call BS. Hemina. I love my portfolio so much. I'm just staring at my portfolio. I'm like, What do I trim? Okay. Yeah, there's not going to be a change in RAM demand for 2 years. And honestly, if it scales at the speed at which I think it will, I mean, they could honestly buy back their own company. Wish I sold and bought back in. What a weak comment to say. Brother, shoulda, coulda, like, if we knew where it was going, I could, I could make every position and trade perfect. If you say I wish in trading or in investing, don't do that. Don't do that. We live here and now. You made the mistake already. So did I. We live. I actually still think I'm green, which is funny. I think I bought in the 430s, but still, I didn't know that the numbers were going to be this good. I had hopes that it would be this good, but yeah. And also, never mind. I did not. And not buy in the 430s. What is the risk to put all my money into Micron for the next 1 year? The worry is that there's some major breakthrough. Like I was listening to Dylan Patel talk about a breakthrough with 3D DRAM and how the cost of this new potential invention is just going to like plummet memory prices. But these are all things that are going to happen after 2030. But that's what I think that the market is worried about is like eventually this is not. I think people are just worried about the general moat and not as much about the squeeze. But yeah. Okay, wait, shoot. I need someone to send me the call right now, because if I can't get on their website, the website cannot be reached for me. Someone needs to send me the link for the call directly to the call. It won't let me reach the site. Okay, all hands on deck. Ladies and gentlemen, I need the webcast. Someone, oh wait, it should be in my calendar too. Discord, X, someone send me the link, because I can't get on the website. Oh, I can also listen through Earnings Hub. There's always a way. There is always a way. My friend, Haribo. Thank you. Wait, what? This says 6 p. No, that's post earnings analyst call. You got to send me the call. I got it in. Oh no, I can't. Okay, I'll go to okay, I'm on. Enjoy.
To Micron Technology's fiscal second quarter 2026 financial conference call. On the call with me today are Sanjay Mehrotra, our Chairman, President, and CEO, and Mark Murphy, our CFO. Today's call is being webcast from our investor relations site at investors.micron.com, including audio and slides. In addition, the press release detailing our quarterly results has been posted on the website, along with the prepared remarks for this call. Today's discussion contains forward-looking statements that are subject to risks and uncertainties. These forward-looking statements include statements regarding our future financial and operating performance, as well as trends and expectations in our business, customers, market, industry, products, and regulatory and other matters. These statements are based on our current assumptions, and we assume no obligation to update these statements. Please refer to our most recent financial report on Forms 10-K, Forms 10-Q, and our other filings with the SEC for more information on the risks and uncertainties that could cause actual results to differ materially from expectations. Today's discussion of financial results is presented on a non-GAAP financial basis unless otherwise specified. A reconciliation of GAAP to non-GAAP financial measures can be found on our website. I'll now turn the call over to Sanjay.
Thank you, Satya. Micron delivered an exceptional fiscal Q2 with stellar records in revenue, gross margin, EPS, and free cash flow. Quarterly revenue nearly tripled versus 1 year ago, and revenue for DRAM, NAND, HBM, and each business unit reached new highs. Our fiscal Q3 single quarter revenue guidance exceeds the full year revenue for every year in our company's history through fiscal 2024. For fiscal Q3, we anticipate exceptional records across revenue, gross margin, EPS, and free cash flow. Reflecting confidence in the sustained strength of our business, I'm pleased to announce that our board has approved a 30% increase in our quarterly dividend. The step up in our results and outlook are the outcome of an increase in memory demand driven by AI, structural supply constraints, and Micron's strong execution across the board. Our memory and storage solutions are at the heart of this AI revolution. Memory makes AI smarter and more capable, enabling longer context windows, deeper reasoning chains, and multi-agent orchestration. As AI evolves, we expect compute architectures to become more memory intensive. This is why we strongly believe that Micron is one of the biggest beneficiaries and enablers of AI. AI hasn't just increased demand for memory, it has fundamentally recast memory as a defining strategic asset in the AI era. We continue to work with customers on strategic customer agreements, or SCAs, that are different from prior LTAs and have specific commitments over a multi-year time horizon for improved visibility and stability in our business model. These SCAs also provide customers greater certainty to plan their businesses while reinforcing long-term engagement across our broad product portfolio. We are excited to have signed our first 5-year SCA. We are making excellent progress ramping our industry-leading 1-gamma DRAM and G9 NAND technology nodes. We expect 1-gamma to become the highest volume node in Micron's history. Our 1-gamma node was already the fastest ramp to mature yields, is ramping volumes faster than all prior nodes in our history, and is on track to become a majority of our DRAM bit mix by mid-calendar 2026. We plan to increase EUV adoption at the 1-delta DRAM node, utilizing the latest generation EUV tools. These more advanced EUV tools will help us optimize both clean room space efficiency and patterning when scaling to 1-delta and beyond. In NAND, our G9 node also remains on track to constitute a majority of bits by mid-calendar 2026. We also achieved a record mix of QLC bits in the quarter. Looking ahead, we expect co-location of R&D and high-volume manufacturing at our Boise and our Singapore sites to speed up time to market for our leading-edge products. We see an unprecedented set of opportunities for memory and storage to enable the AI era across market segments and expect to meaningfully increase our R&D investments in fiscal 2027. Micron's technology leadership, product excellence, and manufacturing execution is being recognized in quality scores from our customers. I'm pleased to report that a clear majority of our customers rank Micron number 1 in quality. Turning to our end markets. AI demand is driving DRAM and NAND data center bit TAM to exceed 50% of the industry TAM for the first time in calendar 2026. Traditional server demand is robust, driven by a combination of demand from workloads initiated by agentic AI, as well as broad-based server refresh. AI server demand continues to be strong. Both AI and traditional server demand are constrained by lack of adequate DRAM and NAND supply. We expect server units to grow in the low teens percentage range in calendar 2026, driven by growth in both AI and traditional servers. We expect server DRAM content to continue to grow in calendar 2026 with the introduction of new platforms. At NVIDIA's GTC, we announced that Micron has begun volume shipment of its HBM4 36GB 12-high in the first quarter of calendar year 2026 and is designed for NVIDIA Vera Rubin. With our HBM4 production ramp and volume shipments underway, we expect to reach mature yields faster than HBM3E. We have also sampled our HBM4 16-high product, which provides 48 GB of HBM capacity in each HBM cube, a 33% increase in HBM capacity compared to HBM4 12-high. Development of HBM4E, our next generation HBM product, is well underway, and we expect to ramp volume in calendar 2027. Our HBM4E will leverage Micron's production-proven, industry-leading 1-gamma DRAM technology node and is set to deliver another step function improvement in performance, enabling a whole new generation of AI compute platforms across the industry. Additionally, HBM4E customization options offer us further differentiation opportunities and even deeper R&D engagement with customers. Micron pioneered the development of LP DRAM for the data center, which consumes 1/3 the power of DDR DRAM server modules. Building on this leadership, we sampled the industry's first 256GB LP SOCAMM2 product, which is built using our 1-gamma node and enables a massive 2 TB of capacity per CPU, quadrupling the content from just a year ago. We see expanding use of LP DRAM in the data center in the years ahead, and we are excited to maintain an industry-leading innovative product roadmap in this market. Rapid growth in AI inference is driving the emergence of new architectures optimized for the token economics of specific workloads. Micron's broad portfolio of HBM, LP, DDR, and SSD is a critical enabler across these architectures. At GTC, the recent announcement of NVIDIA Groq 3 LPX implements up to 12 terabytes of DDR5 in a rack-scale architecture. We are seeing an acceleration in NAND bit demand in the data center due to AI use cases such as vector database and KV cache offload, and due to growing share of SSDs in capacity storage tiers. Micron's data center SSD product portfolio, enabled by our technology leadership and vertical integration, covers the spectrum from highest performance to highest capacity. We are now in high volume production of our G9 NAND-based PCIe Gen 6 high-performance data center SSDs. Our 122 terabyte high-capacity SSD is seeing strong adoption and delivers 16 times the sequential read throughput per watt of a capacity-matched HDD configuration. Our strategy and execution are delivering results. Our data center SSD market share increased for the fourth consecutive calendar year in 2025 to a new record. In fiscal Q2, data center NAND revenues more than doubled sequentially, reaching a substantial new record, and we expect further growth in the quarter ahead. Micron's data center SSD portfolio is industry-leading, and we have secured a robust set of design wins across our customer base. We are now seeing NAND demand significantly in excess of our available supply for the foreseeable future. In calendar 2026, a number of factors, including DRAM and NAND supply constraints, could cause PC and smartphone units to decline in the low double-digit percentage range. Over time, we expect the value of on-device AI to drive strong memory content growth in PCs and smartphones. In PCs, there has been exciting innovation recently with agentic AI applications such as OpenClaw, where AI agents can perform tasks independently on the host PC and also initiate workloads in the cloud. PCs with on-device agentic AI capabilities have recommended memory configurations of at least 32 gigabytes, twice as much as the average PC. Additionally, the fast-growing new category of personal AI workstations, such as NVIDIA DGX Spark and AMD Ryzen AI Halo, come in 128 gigabyte configurations, ideal for using large language models on device. Likewise, in smartphones, OEMs have recently announced new flagship devices such as Samsung Galaxy S26 and Google Pixel 10 with agentic AI integrated into their mobile operating systems. The mix of flagship smartphones shipping with 12 gigabyte or more of DRAM increased to nearly 80% in calendar Q4, up from under 20% a year ago. Micron is well positioned to accelerate the opportunities in these markets with our industry-leading portfolio of products. In PC, Micron completed qualifications for LPCAMM2 at a major OEM. At CES, we launched the industry's first Gen 5 QLC client SSD based on G9 NAND. Micron's LPDDR5X is now designed into leading personal AI workstations, expanding our addressable market with high volumes shipped to key customers. In smartphones, Micron continues to receive strong interest and feedback from OEM and ecosystem partners on our 1-gamma-based LPDDR6 samples. We built momentum with additional qualifications and mass production of our 10.7 gigabit per second 1-gamma LPDDR5X 16 gigabit product. We saw continued pricing improvement across automotive, industrial, and embedded markets. Total AEBU revenue reached a record, with automotive and industrial revenue together exceeding $2 billion in the quarter. In automotive, OEMs are deploying level 2 plus ADAS across their fleets at an accelerating pace. The average car today has less than L2 ADAS capability, containing approximately 16 gigabytes of DRAM, while vehicles with L4 autonomy require over 300 gigabytes. As more advanced ADAS and smart cabin adoption scales, we expect robust long-term growth in automotive memory demand. We have shipped samples of the industry's first automotive-grade 1 gamma LPDDR5 DRAM, and in NAND, we were first in the industry with a G9-based UFS 4.1 automotive solution, further reinforcing our technology leadership in this market. Rapid improvements in AI are supercharging the capabilities of robots. We believe we are on the cusp of a 20-year growth vector in robotics and expect robotics to become one of the largest product categories in the technology world. Humanoid robots will be AI-enabled and will be powered by a compute platform that rivals that of a high-end L4-capable automobile, thus requiring significant memory and storage capacity. We expect this exciting new category of growth to further underpin the long-term favorable dynamics that shape our industry environment. Micron is very well positioned to leverage this opportunity in close partnership with our customers, enabled by our industry-leading technology, product solutions, and operational capabilities. Now turning to our market outlook. We expect both DRAM and NAND industry bit demand in calendar 2026 to be constrained by supply. We continue to expect supply-demand conditions for both DRAM and NAND to remain tight beyond calendar 2026. We expect industry DRAM bit shipments in calendar 2026 to grow in the low 20s% range, slightly above our prior outlook. In DRAM, clean room constraints and long construction lead times, higher HBM trade ratio, higher HBM growth rates, and declining bits per wafer growth from node migrations constrained bit supply growth. We expect industry NAND bit shipments in calendar 2026 to grow approximately 20%. In NAND, some industry suppliers redirecting clean room space for DRAM and overall limited clean room space constrained bit supply growth. We expect Micron DRAM and NAND supply to grow approximately in line with the industry in calendar 2026. Micron is working to address the unprecedented gap between supply and demand, and we achieved several important milestones in expanding our global manufacturing footprint this past quarter. In DRAM, earlier this week, we announced the successful closing of the acquisition of the Tongluo site from Powerchip Semiconductor, completing the transaction ahead of schedule. We expect this site to support meaningful product shipments from the existing fab beginning in fiscal 2028. Adding to the existing fab, we plan to begin construction of a similar-sized second clean room at this site by the end of fiscal 2026. We continue to expect initial wafer output at our first Idaho fab in mid-calendar 2027, and ground preparation has begun for our second Idaho fab. We broke ground on our first fab at the New York site, and initial ground preparation activities are ahead of plan. In Japan, we are making good progress on ground preparation for our clean room expansion to enable future technology transitions in our Hiroshima site. In NAND, the combination of a higher demand outlook and our decision to co-locate R&D clean room in our manufacturing fab underpin our decision to break ground for a new NAND fab at our Singapore site. We expect initial wafer output from this fab in the second half of calendar 2028. In assembly and test, we commenced commercial shipments from our new facility in India. The state-of-the-art facility will be among the largest single-floor assembly and test clean rooms in the world. Our Singapore advanced packaging facility for HBM is on track to contribute meaningfully to Micron's HBM supply in calendar year 2027. We expect fiscal 2026 CapEx to be above $25 billion. From our last earnings call estimate, the majority of the increase is driven by clean room facility-related CapEx, of which the largest factor is Tongluo, followed by construction spend increase in our U.S. fab projects. We project our fiscal 2027 CapEx to step up meaningfully to support HBM and DRAM-related investments. We expect construction-related CapEx to increase by over $10 billion year over year in fiscal 2027 as we build out our global manufacturing sites to address long-term demand opportunities. In addition, we expect higher equipment spend year over year in fiscal 2027. As we make these investments, we will continue to be responsive to the market environment and our customer demand to appropriately align our supply plans. I will now turn it over to Mark for our fiscal Q2 financial results and outlook.
Thank you, Sanjay, and good afternoon, everyone. Micron delivered strong financial results for the fiscal second quarter, with revenue, gross margin, and EPS all exceeding the high end of our guidance. In fiscal Q2, we generated record free cash flow, reduced our debt, and closed the quarter with the highest net cash position in our history. Total fiscal Q2 revenue was $23.9 billion, up 75% sequentially and up 196% year over year, representing our fourth consecutive quarterly revenue record. The $10.2 billion sequential increase is the largest in our history. Fiscal Q2 DRAM revenue was a record $18.8 billion, up 207% year over year, and represented 79% of total revenue. Sequentially, DRAM revenue increased 74%. Bit shipments were up mid-single digits. Prices increased in the mid-60s% range, driven by tight industry conditions and included favorable mix. Fiscal Q2 NAND revenue was a record $5 billion, up 169% year over year, and represented 21% of Micron's total revenue. Sequentially, NAND revenue increased 82%. NAND bit shipments increased in the low single-digit percentage range. Prices increased in the high 70s% range, driven by tight NAND industry conditions and included favorable mix. The consolidated gross margin for fiscal Q2 was 75%, up 18 percentage points sequentially. This improvement was driven primarily by higher pricing and also included favorable mix and cost performance. Fiscal Q2 gross margin nearly doubled from a year ago and was a company record. Now, turning to quarterly financial performance by business unit. Cloud Memory Business Unit revenue was a record $7.7 billion and represented 32% of total company revenue. CMBU revenue was up 47% sequentially, driven by an increase in prices and favorable mix. CMBU gross margins were 74%, higher by 9 percentage points sequentially, driven by higher pricing and cost execution. Core Data Center Business Unit revenue was a record $5.7 billion and represented 24% of total company revenue. CDBU gross margins were 74%, up 23 percentage points sequentially, driven by higher pricing and favorable mix. Mobile and Client Business Unit revenue was a record $7.7 billion and represented 32% of total company revenue. MCBU revenue was up 81% sequentially, driven by higher pricing, partially offset by lower bit shipments. MCBU gross margins were 79%, up 25 percentage points sequentially, driven primarily by higher pricing and favorable mix. Automotive and Embedded Business Unit revenue was a record $2.7 billion and represented 11% of total company revenue. AEBU revenue was up 57% sequentially, driven by higher pricing, partially offset by lower bit shipments. AEBU gross margins were 68%, up 23 percentage points sequentially, driven primarily by higher pricing. Operating expenses in fiscal Q2 were $1.4 billion, up $87 million quarter over quarter. The sequential increase was driven by higher R&D expenses. We generated operating income of $16.5 billion in fiscal Q2, resulting in an operating margin of 69%, up 22 percentage points sequentially and 44 percentage points year over year. Fiscal Q2 taxes were $2.5 billion on an effective tax rate of 15.1%. Non-GAAP diluted earnings per share in fiscal Q2 was $12.20, with 155% sequential growth and 682% growth versus the year-ago quarter. Turning to cash flow and capital expenditures, in fiscal Q2, operating cash flows were $11.9 billion. Capital expenditures were $5 billion, resulting in free cash flow of $6.9 billion. Fiscal Q2 free cash flow was a quarterly record for the company, exceeding our prior record in fiscal Q1 2026 by 77%. Ending inventory for fiscal Q2 was $8.3 billion, up $62 million sequentially, with days of inventory at 123. DRAM inventory days remain especially tight and below 120 days. We reached record levels of cash and investments of $16.7 billion at quarter end and had liquidity over $20 billion when including our untapped credit facility. In fiscal Q2, we repurchased $350 million of shares as permitted by the terms of the CHIPS agreement. During the quarter, we also reduced debt by $1.6 billion, including redemption of senior notes maturing in 2029 and 2030. The weighted average maturity on our outstanding debt is August 2034. We closed the quarter with $10.1 billion of debt and a net cash balance of $6.5 billion. Reinvesting in the profitable growth of our business across R&D, CapEx, and other strategic investments remains our top priority for capital allocation. We are committed to maintaining a strong balance sheet, have reduced our total debt by over $5 billion in the last 3 quarters, and are at our strongest net cash position ever. Reflecting the sustained strength of our technology leadership and cash generation, as Sanjay mentioned, the board has approved a 30% increase in our quarterly dividend to 15 cents per share. Now turning to our guidance. We expect fiscal Q3 revenue to be a record $33.5 billion, plus or minus $750 million. Gross margin to be approximately 81%, and operating expenses to be approximately $1.4 billion. Based on a share count of approximately 1.15 billion shares, we expect EPS to be a record $19.15 per share, plus or minus 40 cents. We expect higher price, lower cost, and favorable mix to all contribute to gross margin expansion in Q3. As mentioned last quarter, Micron's fiscal Q4 2026 OpEx will also reflect the effect of an additional work week in this 53-week fiscal year. We expect to increase our fiscal 2027 OpEx as we ramp R&D investments in support of an unprecedented set of long-term opportunities in memory and storage. We expect a fiscal Q3 and fiscal year 2026 tax rate of around 15.1%. Micron continues to invest in a disciplined manner across our global footprint. To address customer demand, as mentioned earlier, we now project our capital spending in fiscal 2026 to be above $25 billion. In fiscal Q3, we project CapEx of approximately $7 billion, while delivering significantly higher free cash flow on stronger operating cash flow. Due to the need for clean room capacity, we expect our construction spend growth rate to outpace equipment spend growth in both fiscal 2026 and fiscal 2027. Any impacts that may occur due to trade or geopolitical developments are not included in our guidance. I'll now turn it over to Sanjay to close.
Thank you, Mark. Decades of investment in innovation and execution has established Micron as a technology leader in memory and storage, and as one of the semiconductor industry's biggest beneficiaries and enablers of AI. As the only US-based manufacturer of advanced memory products, Micron is uniquely positioned to capitalize on the unprecedented opportunities ahead. I want to thank our team members worldwide whose execution made this outstanding quarter possible. As strong as these results are, I'm even more excited about what's ahead for Micron. We will now open for questions.
Thank you.
We will now begin the question and answer session. Please limit yourself to one question and one follow-up. If you would like to ask a question, please press *1 to raise your hand and *6 to unmute. Your first question comes from the line of Krish Sankar from TD Cowen. Please go ahead.
Mark, the 81% gross margin guide is very impressive. Just kind of curious how to think about the sustainability of gross margins, especially as you bring more HBM4 into the mix. If you can give some color on how to think about gross margins in the August quarter and beyond, that'll be very helpful. Then I have a follow-up for Sanjay.
So Chris, this is Mark. So we provide a strong guide up 600 basis points, sequentially into the third quarter. We're not going to provide the fourth quarter gross margin guidance. However, we have indicated that that market conditions we expect to remain tight beyond 26. So clearly beyond the fourth quarter. What you're seeing reflected in our gross margin is the benefits of AI driving a multi-year investment cycle, most of which is ahead of us. And AI requires more high performance, more memory, and more high performance memory, and that's reflected in the margins. We've talked about supply factors, and those are going to continue beyond 26. The 81% contemplates a growth in HBM4, but we expect, as I mentioned, market conditions to be strong. Now, keep in mind that at these gross margin levels, incremental increase in price is going to have less of an effect on gross margin. But beyond that, we're not providing a fourth quarter gross margin.
Got it. Thanks for that, Mark. And then a quick question for Sanjay on the SCA. Congrats on your first 5-year SCA. How different is it from an LTA? Is this a multi-year volume and price commitment, or does the price get negotiated every year? And also, how to think about cancellation terms in the SCA in case the cycle slows down during the time frame? Thanks, Sanjay.
So thank you for recognizing us for the first SCA that we have completed here. And, as you noted, SCA is multi-year agreement, and we noted that in our remarks as well. LTAs have tended to be, typically 1-year agreement. And of course, in this environment of extremely tight supply outlook, in the foreseeable time frame as well, of course, our customers are very motivated, in order for their own planning purposes and for their better predictability to have these structural strategic agreements with us. And of course, these agreements are really meant to bring stability and greater visibility into our business model as well. We have completed one SCA, so we are not going to be getting into the specifics here of these agreements. I'm sure you can appreciate that these SCAs are confidential in nature. But of course, these SCAs are meant to achieve the objectives for the customers in terms of their ability to plan and be able to count on supply commitments that are in the agreements, but also for us to be able to count on specific commitments that are there from the customers. And, these are meant to go across the periods when the industry is very tight versus, other parts of the industry environment as well. So that's why they're long-term agreements and they have robust terms in them.
Sorry, thanks a lot, Sanjay.
Robust terms in them for us as well as for our customers.
Got it. Thank you very much.
Your next question comes from the line of Joseph Moore from Morgan Stanley. Your line is open. Please go ahead.
Allocation questions by end market. Obviously, the AI is the area that has the most urgency, but do you worry about demand destruction for things like PCs and smartphones? Are you trying to balance big customer, small customer? Just how are you thinking about that allocation process?
I mean, clearly supply is extremely tight and, supply is tight across all end markets. Demand trends are strong across the end markets, while, price-sensitive markets, such as the consumer examples that you gave, may have some demand that is getting impacted due to the higher prices. But overall demand in those markets as well stay pretty strong. And our goal and strategy always is to be a diversified supplier to our various end markets. I think that is very important for us. Of course, data center is becoming a bigger and bigger part of the industry TAM. So of course, bigger portion of the supply goes there. And that's the main driver of growth for the industry as well as for Micron results. But other parts of the markets are important to us, such as PCs, such as smartphone, automotive, of course, industrial. And, we want to maintain that well-diversified mix for our end markets. And I would just like to point out that overall, whether in data center or in the consumer parts of the market, such as smartphone or PCs, the AI trend is continuing to drive greater and greater requirement for memory content. Of course, customers are working, in this tight supply environment to manage the mix of their products. But overall, we are very much working with customers across our end markets.
Great, thank you. And I think in the past, you've sort of said that some customers are getting 70% of what they're asking for. Is that still kind of the ballpark of what you're dealing with? Are there customers higher or lower than that than they were 3 months ago?
Yeah. What we have said is in the last earnings call that some of our key customers we are able to fulfill only 50% to 2/3 of their demand in the medium term. And yes, that still remains the case.
Great. Thank you. Great quarter.
Thank you.
Your next question comes from the line of Timothy Arcuri. Your line is open. Please go ahead.
Thanks a lot. Sanjay, I also wanted to ask about the SCAs. Can you give, I think we're all trying to sort of think on the, to the other side of the cycle and hope that these SCAs provide some mechanism that will kind of limit your, gross margin on the downside to a certain, number. So I know you don't want to give too many details, but is it fair to say that there is a mechanism in these SCAs that would limit your gross margin on the downside when things do finally roll back over?
So, certainly not getting into the specifics of these SCAs for the obvious reasons of confidentiality of these agreements. We have done successfully completed one SCA. We are in discussions with multiple other customers. And if and when we complete these agreements and as appropriate, we will, of course, share further details with you. But what I want to highlight is that these SCAs are multi-year and they have specific commitments in them, and beyond, and these are robust agreements, and of course, these are meant, to absolutely give us the visibility and stability toward our business model. Beyond that, really, I cannot get into any specifics at this point.
Okay, thanks. And then, Mark, I just had a question about cash. So you're going to generate, I don't know, $35-40 billion in free cash flow this fiscal year. You're going to probably have more than $50 billion in cash by the end of the calendar year. So what do you do with this? Are you planning to set aside a bunch of it to sort of buy back a bunch of stock on the other side? And I guess with respect to that, you do have restrictions on the repo from the money you took from the CHIPS Act. Is there any way to get that reworked? Thanks.
Yeah, Tim. So we're thrilled with the performance of the business and the improvement in the balance sheet, and in the second quarter with record net cash and record free cash flow, beating the previous quarter's record by 77%. Our third quarter guide, when you take those numbers and consider the CapEx we gave, we could see cash flow double roughly sequentially. We're going to continue to build on the balance sheet strength and improve our net cash position. We're continuing to delever and pay down debt. Noteworthy that we received 2 credit upgrades in the quarter, so we're now a solid BBB. So we're getting stronger. While, as you can see, we've talked about increasing our CapEx investment and increasing our R&D investment. Now to your specific question on balance sheet priority or capital allocation, balance sheet is always going to be a priority, along with organic investment in our business to advance technology and to put in capacity for value add bits, which we certainly see now. Generating return on capital at this point over 30%, headed towards 50%. We're going to remain disciplined there, though. And then you saw today, we're pleased to announce a dividend increase of 30%, reflects the confidence we have in our business outlook, stability of the business, and cash returns in the future. And then, as you said, we will have, we believe, significant capacity then for returning cash to shareholders through repurchase, combination of offsetting dilution from stock comp, and then opportunistically repurchasing.
Thanks, Mark.
Your next question comes from the line of CJ Muse from Cantor Fitzgerald. Your line is open. Please go ahead.
Yeah, good afternoon. Thanks for taking the question. Wanted to follow up again, the SCA question. So you've had an evolution here, LTAs, binding, now SCAs. I'm curious if you could kind of discuss the breadth of the different customers that you're speaking with. Is it only hyperscale, or are there others that are interested in? And I know you don't want to go into specific details on the contract, but just to follow up on the last question, is there any CapEx forward requirements tied to these agreements? Are there pricing tied to an ROIC on those investments? Any help there would be helpful. Thank you.
So we'll share with you that the SCA that we just have signed is with a large customer. And of course, these agreements are very much focused on, allowing us to invest with confidence in our, future supply plans, and of course also, just having specific terms that enable us to have overall better visibility into the future demand, and as I said earlier, enable stability around the business model as well. And CJ, beyond that, really, we are not commenting on the SCAs other than we'll say that, of course, as I mentioned earlier, these SCA discussions are proceeding with multiple customers, and yes, these are across multiple markets as well.
Very helpful. And then I guess as a quick follow-up for HBM, I think you guided last quarter 40% growth CAGR, which would suggest roughly $50 billion in revenues for the market this year. Has that number changed? And are you seeing any sort of kind of preference for perhaps moving bits to D5 over HBM by any industry players, given today the higher margins that we see there? Thanks so much.
So yes, it is correct that the margins for non-HBM today are higher than HBM margins. Demand for HBM, of course, continues to be strong. We have not updated the numbers that we had provided last in terms of the outlook for the HBM TAM. Of course, the demand for DDR5, LP, and HBM, all of them continue to be strong in the data centers. And, we, of course, continue to manage the mix of the business as the data center AI demand continues to grow. And as I said earlier, we, of course, outside of data center, we are very much focused on making sure that we are maintaining, relevant share in our key other market segments as well. So we are overall in this environment of strong AI demand trends across data center to the edge. We are very much focused on continuing to manage our portfolio, and we see strong growth opportunity for the full portfolio of Microns in the data center. And I'll just point out there that that portfolio is about HBM, it's about LP, it's about SOCAM, it's about DDR5, as well as our data center SSDs which have made tremendous strides in terms of our market share in data center SSDs over the course of last few years.
Thank you.
Your next question comes from the line of Harlan Sur from JP Morgan. Your line is open. Please go ahead.
Yeah, good afternoon and congratulations on the solid results and strong quarterly execution. Maybe Sanjay, to carry on from where you left off on your commentary on SSD. In the November quarter of last year, I estimated that your enterprise SSD business was almost half of your total flash business, right? I think it was up like 60% sequentially. Obviously, a very favorable mix shift from a margin perspective for the Micron team. And as you mentioned, you remain a strong top 3 global supplier of ESSD. Off of that strong number, it looks like your ESSD business doubled sequentially in the February quarter, still 50% of the NAND mix. Looking forward, with the G9 node continuing to ramp, your next generation ESSDs, performance optimized, capacity optimized, mainstream, all on G9, does this give the team a runway to continue to drive sequential growth in ESSD through the remainder of this calendar year and into next year? And then I just wanted to get your thoughts on this new proposed memory tier of high bandwidth flash. Is this an area where the Micron team might start to focus some R&D resources?
So regarding your question on data center SSDs, of course, this is an area of strong growth ahead. And, NAND supply stays strong. NAND supply is very tight and the demand for NAND stays strong. And the data center SSDs are a big driver of, NAND growth here as well. And Micron is well positioned with our portfolio of SSDs, really going across the requirements in terms of capacity as well as performance, across the various customers using TLC as well as QLC, with respect to our data center mix. So very well positioned with this. And, this is as part of our strategy of continuing to shift our portfolio, our revenue mix toward higher profit pools of the industry and, high value parts of the market, we of course will continue to address opportunities for growing our SSD business. We feel really good about the trajectory that we have been on with data center SSD and the trajectory that is planned ahead for us as well. And regarding your question on HBF, high bandwidth flash here. So of course, high bandwidth flash has some positive attributes, such as capacity, but it has the limitations that NAND has, such as write speed as well as power and retention. Therefore, there'll be potentially some workloads here, where this may be a possible solution, but it is really early. And, what is needed, of course, is engagement with the customers here in terms of really understanding the business value proposition of HBF. But we, of course, continue to study this.
No, I appreciate that. And then how much of these multi-year SCA agreements is due to the sort of inherent requirements for earlier and longer term engagement with your GPU, XPU chip customers, just due to the customization of their next generation HBM architectures, right? Especially around the base die. And given the 12 to 18-month design cycle times for these custom base dies, the sharing of IP between you and your chip customers, and optimizing the base die to your process flow, right? It does imply that they have to engage with you much earlier in the design phase for their GPUs and XPUs. Is this another factor driving these multi-year SCAs?
Again, we are not really getting into the specifics, not getting into the specific type of customers here as well. But what I will definitely tell you is that, yes, these SCAs really bring us closer to the customer in terms of, customer as well as our partnership. And that partnership, of course, extends into bringing us closer in terms of R&D collaboration and roadmap planning, both ours as well as for customers. So that's, definitely one of the benefits of these SCAs as well.
Yeah, thank you.
Your next question comes from the line of Tom O'Malley from Barclays. Your line is open. Please go ahead.
Hey guys, thanks for taking the questions and really nice results. So GTC and OFC this week, I think there's a lot of conversation just around the LPU architecture and the increased use of SRAM. Could you talk about your view on the memory market longer term as you see more workloads relying on other types of memory outside of the HBM that you're already using? And then just as a broader question, with so much of the demand coming in these longer term agreements being associated with data center and just a few number of customers that can actually acquire and build these products, how are you benchmarking when you're adding capacity? Do you have an internal forecast for accelerators? Are you talking customer by customer and building bottoms up forecasts? Just so that in year 3, year 4, year 5, that you're offering enough supply to the industry and not getting into a situation in which we're in an oversupply. Thank you very much.
So first of all, on your question on the SRAM and LPU-based architectures, I would just like to point out that, of course, these kind of architectures make the AI infrastructure more efficient. And any architecture that make AI infrastructure more efficient, they're good for all AI. Basically, they help the pie grow faster. Keep in mind that this LPU architecture works in conjunction with Vera Rubin, which utilizes tremendous amount of HBM as well as DRAM. And the NVIDIA Groq LPX, this LPU-based architecture, actually a rack uses 12 terabyte of DRAM in it as well. So all of this actually is addressing the workloads, in a more efficient manner. This helps with, of course, the token economics, the token speed, scale up of AI across inference helps with the power, and every bit that helps overall is good for further scaling up and acceleration of AI demand as well. So we look at this as complementing what already exists with respect to HBM and DRAM, and of course, continuing to grow the pie and accelerate deployment of AI. Just keep in mind that today in the enterprises, the AI deployment as a percentage is still very, very low. And there is, across all verticals, across all industries, across the economies, there is a lot of opportunity ahead. So we are excited about all of these opportunities for our full portfolio of HBM, LP, DRAM, SOCAM, and SSD in addressing these future market requirements. And ultimately, all of this just points to how strategic of an asset memory is for AI, because without more memory, without faster memory, AI just cannot scale up. AI just cannot deliver the capabilities, whether it's in training or in an inference. Just look at from last year to this year, the DRAM requirement in the advanced AI accelerators has now doubled. And so really, and this is what, these are some of the factors that are contributing to the supply shortage. And of course, these trends of greater deployment of AI apply on the edge devices, smartphone, and PCs as well. So we are excited about the opportunities ahead and really, absolutely continue to see strong opportunities for our full portfolio ahead.
Your next question comes from the line of Vivek Arya from Bank of America Securities. Please go ahead.
Thanks for taking my questions. Sanjay, on HBM4, do you expect your share to be in this target 20-25% range right off the bat, or do you think you will kind of build towards it over time? Just conceptually, how do you see the puts and takes in terms of whether you can actually expand your HBM share in this upcoming Vera Rubin generation?
We have shared before that in CQ3 of last year, we reached our HBM target, which we have targeted for calendar 26, to bring our HBM share in line with DRAM share. And we had also said that, going forward, we are going to manage our HBM as part of the mix of our total portfolio and are not going to break out, the share quarter by quarter here. But what I can tell you is that we feel very good about our HBM product positioning, feel very good about overall HBM product. Of course, the market is there for both HBM4 as well as HBM3E in calendar 2026. And we will be supplying both of these products and feel good about our overall position here and our ability to fully manage the mix of the business.
And for my follow-up, Mark, I wanted to revisit this 81% gross margin guidance. I appreciate you're not giving a specific forward view, but what has happened in kind of prior historical peaks where Micron's margins, I think, peaked in the low 60s, I believe. So what is the difference between the prior situations versus now? What have those kind of historical precedents indicated to you about how the trajectory of gross margins can be over the next several quarters? How do customers start to react differently when they see these level of gross margins, and what is a very, very important input into their AI silicon? Thank you.
And before Mark answers that question, can I just point out that I, accidentally said that we targeted to reach our HBM share in Q3 26. Of course, I said it wrong by mistake. I meant that we had targeted to get to our HBM share in 25, and we achieved our HBM share in line with our DRAM share in Q3 of 25. And beyond that Q3 25, we had said we are not going to be providing any further mix of HBM share. So I just wanted to correct what I accidentally said 26 instead of 25.
Vivek, I would say that, keep in mind that the industry is supply constrained. So, and conditions will remain, very tight, and that's beyond 26. So, that certainly supports the near term, medium term pricing, and we've discussed how we're working with customers to allocate best we can to their businesses and work with them on adding capacity, work with them on supply assurance, working them with new products and so forth. I think your question about, reverting to some historical mean, I think maybe, that's the thing that should be revisited is, we have a situation where AI is a transformational secular driver. As Sanjay mentioned, AI requires more and higher performance memory, and this memory helps with the driving the token cost down. It helps lower the energy cost per token. It increases the number of tokens. It increases intelligence overall of AI, which drives harder problem sets and agent use, which drives more tokens and needs more memory. So it's become, the margins are reflecting recognition that memory is a lot more valuable and an efficient way to monetize AI, and that's from data center to the edge. So, and then on top of that, we've been clear for, a year or more that there are, supply constraints that exist on a number of fronts that are that will take time. There are low inventory levels. There's declining bits per wafer on node advances, HBM trade ratio, and that's increasing. And then any new capacity really needs to be greenfield, which is a physical constraint, which takes a lot of time. So these are both, durable factors, both the value of memory and the structural challenge of bringing on supply. And we're working that, both those issues. We're investing in capacity, and we're also increasing R&D to continue to advance the technology and improve the value of memory. And we believe that these will help with margins over time. And I think customers are recognizing that and entering into these agreements.
Thank you.
This concludes today's call. Thank you for.
Yeah, I think, one, you can immediately call the market dumb. I think what people are really worried about is whenever the shoe drops and we feel like we actually do not have a supply constraint, what happens to earnings? Does the margin just get absolutely cut in half? And, clean rooms continue to get developed and pricing is actually on the side of the buyer rather than the seller. And that's all they're worried about. The market can see a few years out, if this is going to be till fiscal 2028, like, how much do you want to bring up the price? I'm not going to let it get to a large percentage of my portfolio. I'm not full porting this or anything like this. These are some of the most unbelievable numbers that I've ever seen, ever in public history. But you want to make sure that they're able to be sustained. And I don't think many people are believing that right now. I'm going to see what happens with the stock overall. And I'm going to learn this company very quickly. And, tonight I'm going to listen to DLocal's call, but I'm going to go through and listen to every call that Micron has put out essentially over the last 2 years and understand this space a little bit more. But it has such an unbelievably cheap forward PE. And if that continues to do 20, 30, 40%, increases in beats, this company can almost buy itself in really quick pace. Like the amount of money that they're going to make from free cash flow during this, bump is crazy. And if you go back, this cycle does not look like any of the other cycles that we've seen before. Obviously, you've seen people point out the waves that Micron has gone through previously. But that's not what we're seeing here. Look at this. Like, Shea Ballor ended up sharing this. Oh, shoot. Okay, wait, one sec. I didn't have my bad. I had the wrong browser open. Okay, let me find it again. Uno momento. Here. Shea ended up sharing this on X. Like, tell me, does this look like some of the past cycles? No, it doesn't. And I know people say like, oh, this time is different, but this time is different. This is the largest build out we've ever seen. So even if it is potentially, let's say a 2-year cycle or something like this, where we do see this massive bump at this level, where this is where we're starting the curve, this could get extremely high. That alone could generate so much cash to end up, buying back a huge percentage of the stock, giving huge dividends. Imagine a 30% bump on the dividend. Now do that every quarter. They could afford it. All right. Ladies and gentlemen, I've been streaming for 4 hours or something like this. And I got to go back on later to talk with Steve at 8 o'clock. I don't know. We'll see. I should record a video, a Micron video, or Nebius. I don't know. Ladies and gentlemen, if you guys like this sort of content, make sure you guys hit the subscribe button. Follow along for more updates. Evan in chat, what's up, brother? Full-time streamer, full-time news reporter. All right. Thank you all so much for watching. Really do appreciate your time. But until next time, bye for now.